Well, it's quite easy to count because I'm from 2000.
The
So in
shadows lurk.
2016,
Tension thickens.
I was very
Exciting.
into
How do
coding at
you
a young
plan to
age, and in
outsmart those relentless
2016, I
foes?
was doing a freelance job, and someone wanted to pay me in Bitcoin. At the time, I've heard of Bitcoin. I originally wanted to mine it to earn some extra money as a teenager, but didn't really have the facilities for that. I got paid in Bitcoin, and well, I only had two options with it. It was either buy drugs or do something else with it, like gambling, etc. And then I discovered this platform called Poloniex, where you could buy alternative coins like Bitcoin, XRP, Ethereum, etc. Against Bitcoin, and basically it was like a mini stock market. And I was like, okay, this is pretty cool because I was always interested in that, but in Belgium, it's very hard to get started on that. We don't really have something like Robinhood, as well, at least not at the time. You need to be 18, at least have like 10,000 euros in your account, which I definitely didn't have at that age. And I basically started, playing around with it. I built up some capital from 2016 to 2018 with a crazy bull market, even though that I had, a very small amount to begin with. And then in 2018, I dropped out to become, a full-time trader.
Did you have interest in any other type of financial markets? Did you follow financial news, or were you just kind of thrust into it by receiving the crypto, thereby awakening your curiosity to it?
Well, investing always had an interest to me because I knew that, like, okay, saving doesn't really, help that much to build up capital. So something like investing would be very interesting. And of course, at a young age, I saw The Wolf of Wall Street, etc. So, you see a lot of people with a lot of money is always interesting as a young guy that was broke. But no, before that, I really didn't have like any experience. Like I looked, sometimes at documentaries, etc. But it wasn't like I had a big interest in it at all. That was also not really at documentaries, etc. But it wasn't like I had a big interest in it at all. That was also not really my start. In the beginning, it was just more as a hobby, and I always wanted my start. In the beginning, it was just more as a hobby, and I always wanted to go, further with what my passion was at the time, cybersecurity. But that quickly changed after 2016.
I see. Did you have early goals regarding crypto through the speculation of it or working other jobs and receiving crypto?
In the beginning, it was honestly more of an experiment. I did set
Receiving crypto?
In the beginning, it was honestly more of an experiment. I did set certain goals for me to achieve by 30, which I prefer to keep private, but I've reached those already. So they were also not really realistic. I thought that I would never really hit them, but well, yeah, apparently
Wow.
I did.
Well, congratulations for meeting your goals early.
Mhm.
When you first got into crypto, or the first few years, did you share your early interest? Or the first few years, did you share your early interest or goals related to crypto with family and friends?
Family and friends, well, I did it because the way that I got started is at the time I think I received like $40. I put $20 into the Poloniex account, and I woke up the next day and I put it into a random coin, and it basically doubled. So that was to me quite surprising. And I remember that I shared it with some friends at the time who obviously. So that was to me quite surprising. And I remember that I shared it with some friends at the time who obviously thought that it was like a Ponzi scheme and whatever. But yeah, in the beginning, I was quite verbal about it because it was very interesting to me that I, had access to a sort of casino where I could speculate on these coins. But yeah, not that much after. I later on I kept it quite private to myself, just because it wasn't really well received that you were, at a young age busy with cryptocurrency.
What was the reaction of your family, friends, or even teachers when you quit high school at around the age of 18 to trade crypto full time?
Yeah, at 18, I dropped out full time to do. At 18, I dropped out to do it full time. I remember my dad. He reacted quite well to it, so I ran away at 16. So it's not like I had contact with my mom anymore. But I remember my last exams. I basically, instead of studying for business development I made a presentation for my dad explaining that I was gonna, drop out of high school, and he didn't really have a choice. Like, he either is gonna have to support me with it and just accept that I'm going to do it, or that I'll be, that I'll leave the house. that I already found an apartment where I could stay, that I knew I could afford, etc., etc. And he basically was quite. He accepted it quite well. He even said to me like, "Yeah, I knew you were going to do this, but of course I cannot really verbally support it that you drop out of high school. I'd rather have you finish it first and then drop out. But well, I cannot really stop you." When it came to my friends, they were kind of in disbelief, and I remember I told my teachers a few times that I'm just going to drop out, and they didn't really believe it. But then the day that I needed to get my last grades, they were in full disbelief when they wanted to register me for another year. That I said like, no, it's not going to happen. I'm dropping out.
Oh, wow. Did you share with them some of your early successes in trading crypto?
There was a teacher from another school that I shared it with because he was also interested in economics. He was a math teacher, but he didn't see me at later stages, and I didn't have contact with him anymore. Also, the teachers that I had the last year, I basically never shared what I exactly was doing. They knew that I was interested in crypto because sometimes during the lectures I wasn't paying attention to them at all, especially during computer class. I was doing my own thing, which kind of bothered them. But no, I never really shared it with them because, again, especially in 2017, 2018, even though it was in the media, it was still mostly seen as something used by criminals, terrorists, drug dealers, etc.
So what makes crypto fascinating for you? I mean, what really grabs you about crypto?
Well, in the beginning, especially 2016, 2017, there wasn't really much special about it. But the thing was that it's so open. You can easily get into crypto, especially at the time. You could just create an account without doing any KYC. You could deposit a small amount of money and you get charged in percentages, not really in standard fees, which makes it attractive for a young person like me. And also the data is just so open compared to traditional markets. If you want something like order book data, etc., especially live data, you're going to have to pay thousands a month compared to crypto, where it's just like, okay, you have an account here, even though you have $10 or $20 in your account, you can create an API key, request data, and just use that. It's very open and transparent. They don't treat you differently because you're from a different country or whatever. Cryptocurrency just works like it should. There's certain code that the code gets executed, and there's no regulation in between. Well, now it has, but not back in the day.
In your earlier years of trading, what type of cryptos did you buy
I mean,
or trade?
the biggest garbage out of all of them. I remember that I was trading one coin quite heavily called Sia coin, which was something that had to do with cloud storage. So you could, instead of mining, you could provide some storage to the network, and then people would rent that storage from you on the decentralized network. And I found it a quite interesting coin because back in the day you didn't really have stable coins, or at least they weren't big, so all markets were denominated in BTC, and this coin was so cheap. So in the smallest unit of bitcoins or satoshis, it was like 67 satoshis. However, the fees that you paid to take and make from the markets were less than 1%. So for me, it was quite attractive to just constantly place bid and ask on it, and kind of do some small market making, but manually, to earn some extra money.
I see. So you were more
Money.
I see. So you were more of a market maker / short-term trader as opposed to kind of a buy and hold.
Well, I did buy and hold, but I did a lot of experiment. Well, I did buy and hold, but I did a lot of experimenting. Yeah, no, I wouldn't really say that I was heavy busy with that. I was in short-term speculation. Market making really wasn't the case yet in my earlier years. My knowledge about markets then was also very minimal. But yeah, back then it was mostly short-term speculation, some long-term stuff. But the coins that I was trading at the time were, many of them were garbage or even outlined scams. But that was what got traded the most back then. So, I went where volume went.
Mm-hmm. I'd like to transition to the idea of the perception of crypto in the media. Frequently, we hear the media and some politicians and bankers frequently say that Bitcoin mining is consuming more energy than some nations, and that mining is consuming more energy than some nations, and that cryptocurrencies as a whole are primarily used by criminals for money laundering. What's your response to this?
When it comes to the electricity usage, I don't know the exact numbers that already heavily dropped after Ethereum switched from proof of work to proof of stake. When it comes to Bitcoin mining, of course, it still uses a lot of electricity, but I do know that the people that have mining facilities, they go to places where electricity is cheap or where there is too much electricity produced, so that they can buy it for cheap and mine Bitcoin for cheap. So I don't think they should only look at how much electricity gets consumed because of Bitcoin, but also at where the electricity is coming from. Because if it's at a place where they just have way too much energy and they cannot, send it to another place, then it's quite logical that why not use it for for Bitcoin mining instead. When it comes to that cryptocurrency gets used by criminals, that's definitely true. But you got to keep in mind that with Bitcoin and other cryptocurrencies, you can at least see that it's getting used by a crime. If, for example, a bank gets hacked or there's a malicious transaction on your PayPal account, we as a public don't see that. When it comes to cryptocurrency, there's a public ledger. So if someone is verbally about the fact that, hey, this money just got stolen from me, we can see that actually the money got sent to a different address, maybe linked that to another hacker, etc. So it definitely gets used by criminals because it's fully permissionless, and it's not like PayPal, for example, can just freeze your funds. But at least we can see that there is crime, but it's not really appealing for many criminals because you're leaving a trace behind permanently with something like a PayPal account. If your PayPal account gets closed, that data is deleted, or maybe PayPal still has a copy of that. But when it comes to cryptocurrency, let's say that you steal some Ethereum from someone, you are leaving a trace behind. Even though you are using a mixer or something like Tornado Cash, if that ever gets traced back to you, you're screwed.
Yeah, so certainly cryptocurrency is not the best way for criminals to keep their transactions private. And I've heard that the percentage of criminal activity using cryptocurrencies has been falling as a percentage of total volume over the years. I'd like to dive into what is quantitative trading on the cryptocurrency market. You're a quant trader yourself, correct?
Correct.
Yeah, why would we consider quantitative trading over, say, traditional discretionary trading?
Well, when it comes to quantitative trading, the easy thing that you have with cryptocurrency, again, is that the data is so open. You have easy access to order book data, live trades, etc., that you do not have on traditional markets. I forgot what question you asked.
Oh, yeah, why should we consider quantitative trading over discretionary trading, the advantages? You mentioned that in the crypto market. Is it easier to do quantitative trading on the crypto market than the traditional financial markets?
Yes, it's definitely easier just because the data is so much more open than on the traditional markets. Something like the cryptocurrency markets, you can open an account at an exchange, request the API, and have full access to it with certain limits, of course, but you have full access to the data compared to the traditional markets where you don't have that.
I see. And did you program yourself?
Yes. So before I got into trading, I was very into just scripting as a kid, building small programs, etc. So then in 2018, when I went full time as a trader, I was looking at ways to basically improve myself. And the best way to do that in the beginning was to build tools for myself, things like different methods to enter a trade, analyze my trading history, look at try to build some kind of automated trading strategy in the beginning.
I see. What kind of strategies did you try?
Well, back in the day, it was actually quite simple stuff like trend following, etc. That has now evolved to fully delta neutral strategies and strategies based on order flow. Mostly with order flow, it comes to trying to find trapped players. So players that got into a position are now underwater and aren't in favorable conditions, and then try to make use of that.
So you tried different strategies. How often would you switch between strategies?
It depends from time to time. Some strategies were profitable back in the day. Now, they aren't anymore. I remember in the very beginning, it was on Binance, for example, you had so many different pairs like BTC USDT, but also BTC Ethereum, Ethereum USDT. And between those three pairs, even though it was on the same exchange, you could execute some tri-arbitrage. Now, basically what that meant was, let's say, buy Bitcoin, then use that Bitcoin to buy Ethereum, and then use that Ethereum to sell for Tether or USDT again for a small profit. Back in the day, that was still possible, but these days, that's, the competition has gotten too high. You have companies like Alameda, Wintermute, Jump that are now way faster and have a way better infrastructure than me to execute those trades. For example, now it's more order flow based, or strategies that aren't latency sensitive.
So you said you got into arbitrage. So what is arbitrage exactly? Is it just price differences on different exchanges that you're taking advantage of?
Price differences between different exchanges, or also just different trading pairs. So like Ethereum USDT, Ethereum BTC, and BTC USDT. You could use your USDT to buy BTC, then convert that to Ethereum, and then sell that Ethereum on the Ethereum USDT for a higher price, because there was a small difference between those.
I see. And the higher price that you're selling it for, this is between different centralized exchanges, or are you also doing this on the decentralized exchanges?
I've never done it really on decentralized exchanges. I was quite late with the whole DeFi trend. Back in the day, especially in the early days, I did it on centralized exchanges.
How often would you see these type of arbitrages come out to take advantage of it? How frequently would you see it?
Back in the early days, I can't quite remember, but it definitely happened multiple times a day that I saw it on different trading pairs. But the markets were, then so inefficient that you could just arbitrage them out by hand. Especially between different centralized exchanges. Most of the times you could just buy on one exchange and sell it on the other, and you could have minutes of delay, or not be the first one for minutes, and still be able to make a profit out of it. But that was, again, back in the day. These days, everything has gotten so much more efficient, and these types of strategies I don't run anymore, because the competition has gotten real tough, and also the infrastructure of decentralized exchanges has gotten so much better. It's honestly a whole different world now.
I see. So these days, you don't do arbitrage too often, or?
Not when it's latency sensitive. The type of arbitrage that I still do these days is cross-exchange funding arbitrage. So a funding rate is basically a fee that shorters pay longs, or longs pay shorters, depending if there is a premium or a discount on a perpetual contract. Now, this premium or discount is different on every single exchange, even though it is for the same instrument. So you could have one exchange like Binance where you get paid to long Ethereum, and then you get paid to short Ethereum on an exchange like FTX. And what I will do is say, if the reward is high enough, long on one exchange, short on the other, and basically make the difference, make a profit on those funding payments. And then also when that spread closes.
Could you describe for our listeners what is a perpetual contract?
A perpetual contract is like a future contract, but it doesn't have an expiry. So to make sure that the contract price is still close to the index price, so the actual price of, for example, Bitcoin, what we have is a funding rate. This funding rate gets calculated by the average premium on a certain time frame. So let's say that a funding rate gets paid every 8 hours, like on Binance. It would look at the time-weighted average price of that 8 hours, and then if it's, for example, positive, longers would pay shorts that difference, and if it's a discount, shorters would pay longs.
Why does this funding rate differ from exchange to exchange? And I mean, why does it even exist in the first place? How does that get created?
Well, the difference in it's quite simple. If there is the index, it all depends on the index price. So this index price is different on every exchange. Why? Because it gets calculated in a different way. So, for example, on Binance for BTC USDT perpetuals, they would say, okay, we're gonna give 50% weight to our BTC USDT spot market, and then 20% on UOB, 20% on KX, 10% on another exchange. While an exchange like FTX could say, oh, we're not going to do that. We're going to give a weight to the Binance BTC USDT market for 20%, UOB at 20%, or KX 20%, and basically have a very different, index calculation. And then there's also the thing where, different traders on different exchanges maybe have a desire to create exposure to a specific coin, but cannot go to that other exchange or don't want to move their capital to that other exchange and then buy more aggressively or sell more aggressively. And because you have the different calculation on these index prices, and also just traders on different platforms act differently, you get these funding rate differences.
I see. So how long do you typically see these funding rate differences last for?
Honestly, it really depends, because sometimes it is just like one funding rate period, but most of the time I try to ignore those. But sometimes it's also days or weeks, especially in the bull market. You saw these extreme funding rates sometimes last for weeks, even though they were crazy fees, simply because there was so much demand and people wanted to utilize as much leverage as possible. So it really depends from market to market. Sometimes it's one funding rate period, but those mostly get ignored. But if it's if it lasts a day, they get noticed by everyone.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So these funding rate differences are created and amplified by a lot of volume, transaction volume that helps push up prices. Is that where the inefficiency comes in? Is it less during a really quiet market?
It's definitely less in a way more quiet market. It is always because of some big events. So currently the funding rates on big coins like Ethereum, like the premium that you pay on these funding rates aren't really that high. I would say like a 2%, 3% APR last time that I checked. But on big bull market, it was sometimes 50% APR. That you were getting paid in a specific direction, sometimes even crazier. I think the peak of 2021 on Bybit, you got paid 2% a day just to be short on Ethereum, which is absolutely nuts because a guy like me is just going to buy Ethereum, use that Ethereum to short Ethereum, and get a 2% payout every day while actually having no risk.
Wow, you say there's no risk because you're long.
You have no exposure to the underlying assets. So with the specific one that I'm talking about on Bybit now is I use Ethereum as collateral to short the Ethereum contract. So let's say that I had 1,000 Ethereum, I would use that 1,000 Ethereum that I had in spot, then use that as collateral to short Ethereum, the contract itself, and then I would bag the payout that Bybit would give me simply for being short. But if it would go up in price, well, since I own the Ethereum, I have no underlying exposure, I would be safe. If it goes down, well, my Ethereum becomes less valuable, but because I'm in a short position, I'm fully hedged.
I see. You wrote an article talking last spring about receiving $309 a day for just one Bitcoin, and you're protected on the downside through this delta neutral. How much has this funding rate changed over time? Because this number equates to over 100% annualized payment.
Yeah, but when it's a crazy rate like 2%, it most of the time doesn't last for that long. Over time, like now, rates have normalized again. I personally don't really know what they are at the moment. I haven't checked in a bit. Like now, I'm now checking it on Bitcoin, for example. The best that I can get as we speak is currently 1 BPS every 8 hours, which isn't that special. But also there isn't, a lot of volatility currently on the Bitcoin markets. There hasn't been a big down move or up move for a while. We've been going sideways for almost half a year. So people aren't really, aggressively betting.
I see. So what kind of strategies do you tend to favor during these times of quiet market activity?
The strategies that I currently favor is actually most of the time none. At the moment, I'm busy building further down my systems that I wanted to scale out or start experimenting with new strategies. And I'm basically just waiting on volatility. Now, these days, as the time of this recording, we've received some volatility again, especially on pairs like Ethereum. So I'm trying to, play around that, but that's mostly directional order flow. But besides that, at the moment, if markets aren't favorable, then I'm not going to force myself to trade, and I rather sit back and just try to improve my systems or build out current operations further.
Have you heard of the kimchi premium?
Yeah, I've definitely have. The Korean premium that Sam Bankman-Fried and Alameda Research are well known about. You're talking about that one, right?
Yes.
Yeah, definitely. I don't know what the percentages were, but back in 2017 on the Korean exchange BitHump, I think, there was a sudden premium on Bitcoin of over 50%, if I'm not mistaken. And what Alameda Research back in the day did was because it was so difficult to, arb that out from a legal perspective, I cannot really remember what it was, but I thought that you couldn't withdraw your Korean won to the USA or something like that. So what they did is they put people on a plane, sent them to Korea, let them open a trading account there, and basically by hand arbitrage it out. But I could be wrong there because it's been a while since I heard the story. But there was a wild 50% spread, well, 50% premium in Korea that they arbed out.
Wow. So I assume nowadays these kind of premiums, they don't no longer exist. Has the markets become much more efficient?
The markets definitely have become way more efficient thanks to stuff like stablecoins, better regulation, just overall also market makers now popping up in this space. Back in the day, because volumes were extremely low, it wasn't interesting for a market maker to build out that infrastructure, and especially because exchanges were very flawed. But these days, you don't really see wide premiums like that. If you want to see wild premiums, you would have to go to something like DeFi. But on DeFi, these premiums have gotten way lower, maybe 2% these days on low market coins, but low caps. But no, you really don't see them anymore these days.
Mm-hmm. Have you gotten into DeFi?
I've gotten into DeFi, but not from a quantitative perspective. I have to be correct there. I have gotten into it from the quantitative perspective, but not into stuff like, for example, liquidity providing. So you have automated market makers providing liquidity for them. I've done that by hand, but not really in any quantitative or automated sense. What I have utilized though is on decentralized exchanges, you now also have perpetuals, where you can, again, with the cross-exchange funding arbitrage, you can get some good trades. I've definitely taken advantage of that. And I'm also now working together with a few DeFi protocols, advising them on how to improve their systems, etc.
Oh, wow. What do you see are the biggest advantages and disadvantages of going through DeFi?
When it comes to DeFi itself, DeFi has advantages in the way that it's just open and free. So like the thing that I already liked about cryptocurrency, that you easily get access to data, etc., that is only stronger in DeFi. There's no more, there's not even private data anymore. Everything is public. You can request as much data as you want. You can send you have no rate limits like you have on, for example, a centralized exchange. So that is very nice. You have better, you have alternative liquidity solutions. So for example, with trading, you have AMMs, so automated market makers, that they aren't really better, I would say, but it's a nice alternative to have. And it's just better, it's, how can I say this? It's easy to start a finance startup on DeFi compared to, anything else in normal finance, because you can just start up a smart contract and start your own, decentralized protocol or decentralized application.
Mm-hmm. Do you ever get involved with NFTs? Any kind of trading strategies?
With NFTs, I'm involved as an investor. I've, taken a few positions. I don't know if I'm allowed to say names or not, but for example, two NFT projects that I like is Miladies and Pudgy Penguins. Miladies, purely because it's both of these projects are profile picture projects, but what I find interesting is both of them have a very good community. Miladies are more private parties type of situation, while Pudgy Penguins is more of a wholesome community that tries to help each other out. They also do some interesting stuff with IP licensing. So the penguin that you own, they could utilize that to, have some kind of, how can I say this? What is it correctly? So Pudgy Penguins, what they do is they could, since the intellectual property is yours, when it comes to Pudgy Penguins, you also have a wholesome community, but you own the full IP rights to the penguin that you own. However, what you're trying to do is enable that IP. So, for example, try to get a licensing deal with you to build real life products. So the guy that recently bought up the project called Luca Nets, he has a history with creating toys, Gel Blaster specifically. What he's now trying to do is try to get IP licensing deals of your penguin to then make plushies with it and sell them to Target, Walmart, and other stores, which, when I heard that pitch in the beginning, I thought was kind of bullshit. But since he has this, good history of already creating toys, one of the best-selling ones in America last year, it gives a lot of hope and makes it an interesting project. They also are now busy with storytelling, like an animated series, etc., and are, trying to create really a unique and interesting approach. For trading NFTs itself, something that I've been looking at is trying to arbitrage them out. So since non-fungible tokens, they're not like a Bitcoin. One Bitcoin is a Bitcoin. There's no difference between them. However, with NFTs, because you have one item of a collection, it's not the same as the other one. It's, for example, with the example of penguins, it could be the one has a crown, the other one doesn't. Difference in skin or fur, background colors of that picture, which causes some liquidity issues. However, now you have these automated market makers like NFTX, SudoSwap, etc., where you always have a bid and an ask. And sometimes these price differences get very big, especially compared to more centralized platforms like OpenSea and LuxRare, where you can execute an arbitrage. But it can be really difficult because trading fees on these NFTs can be very expensive.
For our listeners, can you describe very briefly what are NFTs, non-fungible tokens, and how do they add value?
Well, NFTs, what they are in short, is a sort of unique token, and that can be anything from a piece of art to a concert ticket. Those are the two prime examples. You've probably seen them before, like a Bored Ape Yacht Club or a CryptoPunk. And how they add value really depends from the collection. If it's something like a profile picture, you most of the time get access to an exclusive community. It's kind of like a sign of wealth sometimes too, especially the Bored Apes and the CryptoPunks. I think the cheapest one on both of them is at least 6 figures. So having a profile picture like that, it's just a status symbol, just like a Rolex. The other utility that you have really depends from project to project. Some, like the Miladies, give you access to private parties. Same with Bored Apes. Some of them just give access to, a group chat or part of a community, but it really depends. But the most interesting part for me is just, it's ownership. you get the NFT in your cryptocurrency wallet, and everyone on the blockchain can see that you own that NFT, and it is from that specific contract address. It's not like, going back to the Rolex example, someone sees you with a Rolex, but is it a real Rolex? You don't really know. It can be a super clone, it can be a very good fake. You have no idea. But with cryptocurrency, you can see, okay, that is number, let's say 1,000 out of the 8,888, and we can all see on the blockchain that it is from the blockchain it is from that specific collection that we are talking about. So we know that it isn't a fake. It's truly just ownership, in short.
I'd like to move the conversation to talking about March of 2020, when the crypto and financial markets had a big fall.
The Luna crash.
Yeah. And what happened briefly in March of 2020 with crypto, other than the prices falling? Was there some issue with the crypto exchanges, and have those issues been solved now, or been improved upon?
The biggest issue at the time was, of course, the UST collapse. So there was this cryptocurrency project called Luna, which, think of it as like an Ethereum competitor, but they also had a algorithmic stablecoin. What I mean by that, it's an algorithmic stablecoin. It's a stablecoin, and the peg, which is $1, is remained by an algorithm that was based on the Luna blockchain. So if UST was below $1, they would use Luna in the treasury to sell for UST, and if UST was above $1, they would use Luna. They would use UST to buy Luna. But back in the day, what happened was that the peg difference got really big, and since UST was, I think, 96 cents when it really started going hard, they aggressively started to sell Luna to buy UST. Now, because there was a DPEG, no one wanted to buy Luna, so Luna got into a debt spiral, and UST never recovered. So many people, lost all their money. And a lot of exchanges had trouble keeping up because, the trading that happened on Luna was so aggressive, which also, brought down every other price. And well, yeah, that's in short what happened.
Great. What is it like for you setting up a quant fund as a young entrepreneur? What was the motivation for you to start in the first place?
Well, for me, I actually originally just wanted to start a prop shop. So I had my own capital, was quite happy with it. And, for me, it was, especially in big bull market, it was always a trade-off of either you trade, you build your systems, or you need to maintain your systems, build it out to newer exchanges, etc. But it was always a game of catch up. So I was like, okay, I need to hire some new people. The moment that I got a bit verbal about that in my friend circle, there was a certain financial institution that said, hey, we would like to create some cryptocurrency exposure, and we would like to do that through you. I thought that it was going to be quite easy to do, start up a fund somewhere like Cayman, and then raise some capital and call it a day. Burned my fingers on that because the financial institution that I was in contact with is very traditional. They cannot just use Cayman, for example. They told me that they could only do it in a fund located in Luxembourg or Switzerland or something like that. They're pretty open-minded with that. And well, that took at least a year to set up. I think 1 year and 3 months in total. And after setting up, it became a problem because there was, I'm sorry, my microphone disconnected. Do you hear me?
Yeah, I can hear you fine.
Okay, shit. Sorry, my microphone just disconnected for a bit.
No problem.
The cable got pulled out.
Great. Do you know anyone else running a quant fund in the crypto sphere?
Oh no, there definitely are. You have mostly market makers, so more traditional delta neutral strategies like Alameda Research, Wintermute, Nibio, Folkfang, and many others. Now you also have Sandcap, which is run by a friend of mine. You have Manyfold. There are many others, but there aren't many that do it in Luxembourg, which is quite unique. Mostly, because it's hard to set up there. It's very expensive, and just a legal headache that you have with them is, since Luxembourg is slow-minded and they move slow, it's not something many want to deal with.
So you hire programmers to help you build out your system. Is that correct?
Yeah, I did hire one guy full time. His name is Munir. Basically, I picked him up right after college. After university, he got a master's in AI and then applied for the job with me.
Mm-hmm.
And besides that, I currently don't have anyone else, but we're looking to hire someone who has more experience with DeFi pretty soon. Mm-hmm. And also just another senior programmer to speed up our systems, because currently, building out to newer exchanges takes a lot of time.
In your article, you mentioned that you designed your system to be a microservice architecture. Mm-hmm. What is this, and what are the advantages?
Think of it as like normal programs, how they work. It's like a stack built on top of each other. It is a one big robot that you build. Monolithic programs, it's called. The issue is, of course, with this one big robot is that if one part of the robot breaks, your whole system falls apart, and it can create a lot of issues. While what we're doing is we're building a small army of all different kinds of robots. But if one robot goes down, it doesn't mean that the whole system goes down. And the others can notice, like, okay, there's one system that currently isn't operating, so we can spin up a new instance of it that can replace it. An example of this could be, let's say a risk engine. So I would have my terminal. I want to execute a specific trade as a human. I submit it through my terminal. The terminal wants to go through the risk engine to our API to place a trade. But we notice that there's something wrong with the risk engine. It doesn't respond. There's an issue. There's something wrong with it. In a normal program, everything would just be stuck and you wouldn't know. With us, it would, it sees like, hey, there is no reaction. We spin up a new instance of it. We submit our transaction to the new instance, and then it would, send it to the API and work just fine. And that's with every small piece that we have in our systems.
I see. So this type of design, is it built to be more resilient, say during when exchanges freeze up, or any problems that happens with the exchanges that's occurred in years in the past? Does this help protect you a little bit from that?
Definitely, because if there's like one error, we can spot it more easily. And it's also very important for scalability. So let's say, we have our current systems in place, and most of it is written in Python. But let's say there's something, very heavy to run, which Python is too slow for. We could rewrite that microservice in a language like, for example, Rust, which is way faster, but it takes a longer time to write it in, and we could basically replace it with that quite easily. Just like that, spin up a new instance, but then in Rust, if we have developed it and replaced it, and it would work just fine. Think of it as like a piece of your car. If the engine isn't fast enough, but back in the day it was, we can now just replace it quite easily.
So for your crypto fund, are you targeting individual or institutional investors?
Mostly, technically anyone that is high net worth, but we definitely have a preference for institutionals, because to onboard them, it's more easy, and also the minimum ticket size in Luxembourg can sometimes be quite high for angels.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
How much new competition do you see entering the field, or is it difficult to track?
It's quite difficult to track because quants like to keep a low-key profile and don't really, shout it out like, hey, we're starting a new quant fund. But most of the competition that we see is more from the VC perspective. So early investors, seed investors, not really people that, actively trade or run liquid strategies. I think this also comes because of the attractive period that we had in 2020, 2021, where VCs, a lot of them just did prey investments, and sometimes they went up by 100, and sometimes they went bust. But VCs, had an incredibly easy time. Then I've seen that friends of mine, but also competitors, are now attracted to that way more than running a traditional hedge fund.
Mm-hmm. So to effectively utilize your strategies, have you calculated roughly what is the maximum amount of money that you could manage and still be effective?
We've noticed that if we keep it below 30 million, we're going to be fine with our current systems, but it's quite easy to scale that up because the issue that we have is just liquidity overall with the types of strategies that we run. Since we are mostly directional, we can manage quite a large sum in overall, but the liquidity, of course, on lower cap coins is very spread out. So for us, if we want to go above that 30 million mark, we're just going to have to connect to more exchanges and perhaps also more OTC platforms.
So where do you see yourself, or where would you like to see yourself in 3 to 5 years?
It's a difficult question to answer because if you asked me that question 3 to 5 years ago, I would have said that I worked in cybersecurity. Um, Honestly, I would say kind of the same place where I am right now. Like trading isn't really a thing that I'll quit soon. I've tried to quit it in the earlier days or even other periods, but I always get attracted back to it. So I think that I will always stay in this space, running this shop, especially for Musca itself. It's something that I want to do long term. I want to do it for at least 10 years, not leave anytime soon. I want to scale it out, actually, not scale it out as not only the fund, but also building something on top of that. Think of something like a Bloomberg terminal for cryptocurrency, for centralized exchanges and stuff like that, where my expertise is, where I have some expertise. So yeah, I would say that just further with the building out the fund, advising projects. There are now a few projects that I'm that are going to be announced soon that I'll be advising. I'm very stoked for that. And honestly, I just want to stay on that path.
Great. I had one question regarding regulations, and
Mm-hmm.
some say that some kind of regulatory framework is necessary for big institutional money to get involved. What's your
Mm-hmm.
take on that? Do you think we need some kind of regulation for the big money to come in?
Regulation for the big money to come in. Well, it's hard to answer that question because you have regulation, in the USA, you have that in the EU, etc. I don't really think you need more regulation because at the moment the regulation is already pretty strong, especially and now especially there's a lot of work going around MiCA law, for example, in Europe. You have the USA where Sam Bankman-Fried is pushing really hard for regulation. I think it's more of a liquidity issue. At the moment, liquidity has gotten way better in crypto, but it's not like you can execute a $100 million trade quite easily on the crypto markets. That's going to take days, or at least have a big market impact on even coins like Bitcoin and Ethereum. I think it's more of a liquidity issue and an overall adoption/interest issue than regulation.
Mm-hmm. I'd like to move to mindset and psychology.
Mm-hmm.
And is the mindset different for a discretionary trader versus an algo trader?
Definitely. Well, for me at least, because when I was a discretionary trader, I had like a more, how can I say, a long-term view around trading strategies. Well, now as an algorithmic trader, because I'm so into the data, I try to optimize every small part of it. But as a discretionary trader, what I did was I placed one single limit order, or I placed one market order, or whatever. And that now has become to, okay, how do I, for example, optimize my entry? And it's not only the type of orders that I'm going to use, but also which exchange am I going to use it? Which exchange am I going to execute it on? Back in the day when I was a discretionary trader, what I did was I want to trade a 1,000 Ethereum long. I go to the exchange that I use and I execute a 1,000 Ethereum long. These days, it's very different. I have my own terminal. I type in, I want to create exposure to 1,000 Ethereum. And it's going to look at, okay, where do I have money on which exchanges, at which exchange do I have the best rate, so to say, to enter this trade based on prices, liquidity, maybe things like funding rates, etc. And then it's going to execute that trade, but not only on one exchange, but most likely on multiple different exchanges all at once. And with a discretionary trader, for me, I did a lot of manual work. With now as an algorithmic trader, it has really changed to, since I now have way more time because I automated a lot of my workflow. then I'm spending more time optimizing my systems or building them further out than actually, trading itself.
So what do you struggle with most, and how do you deal with it?
Struggling with most is decide where I'm going to invest my time and resources to, because cryptocurrency grows so incredibly fast, and you can have the mentality of like, okay, I have this one thing that's now very popular and very cool that I want to expand to, but that maybe not be interesting in tomorrow or next week or next month. So it's constantly a decision of like, okay, am I gonna spend more time building out to this new exchange? Am I gonna learn more DeFi related stuff on this specific chain, or am I gonna learn options? It's really where you're just gonna invest your resources, both time and money wise, because the space just moves so incredibly quick.
Right. There's more things to learn than you have time for.
Yeah, and it's too much for everyone because there's just so much new stuff going on. The last Arbitrum, for example, is getting very popular, which is like which is a new chain. Well, not a new chain, but well, whatever. It's a new ecosystem basically. You now also have new memes, which sound very strange to say, but coins like Dogecoin, Shiba Inu, etc., are very big, and now you have Dogechain, which are getting a lot of traction. It's like, okay, is it worth to spend your time on that or not? You're going to have to invest some time in it, perhaps because it's going to get big, or maybe it's just a fad that lasts for another week. But at the same time, you have, I don't know, a new decentralized application that's coming out that's maybe interesting because it's a new derivatives exchange where inefficiencies are created. It could be something NFT related that can be interesting. Maybe a new fraud or a new scam got invented. Maybe you got to spend time on cybersecurity. It's just so much. And even if you have a team, it's a pain in the ass to keep up with.
Yeah. So how did you quickly get to where you're at your age? Did you have mentors?
I didn't really have mentors. I just had, because all the resources are on the internet. It's, something that fully got invented on the internet. You have all the resources, but I learned a lot through social media, which sounds strange to say, but through platforms like Twitter, private Discord chats, etc., where you meet people that are into the same stuff as you. You talk about it and you build together and you experiment together and you teach each other stuff. And that's, the thing that enabled me to learn quickly. Also, just the thing is about crypto is not only is data so open, but also the founders of these protocols or exchanges are very open. So a lot of the times, like an exchange like FTX back in the day, when they launched, I had some questions about how they designed their liquidation engine because it was so different than anything else that was in the space. I would just DM the CEO, who's now incredibly big, but at the time he wasn't. And I just DM'd him a question saying like, hey, I don't really get this part, or like, why did you design it this way and not design it this way? And I would just get a response. So I don't know, just fucking around and finding out.
Yeah, those early days, you felt like you were part of a community, right?
Now these days too, like especially around DeFi, everything is very open. With DeFi protocols, you can just join a Discord, you can ask questions, and you have people that are paid full time to just answer your questions, or even the community is just going to answer what you're asking for, or send you a link where there's further documentation. With cryptocurrencies, you really feel part of a community. I don't know how it is on platforms like TikTok, etc. I don't think it's really I don't think it's going really well over there. But on platforms like Twitter, everyone is very open. Like even big traders that are running way bigger firms than me are just very open to talk about stuff. Some I don't know how to pronounce his name correctly. Some Tobacco, I think, but everyone calls him Tabasco. Was the CEO of Alameda Research. And for a while, he would just post his analysis after doing the trades publicly on Twitter for everyone to read. And these were very valuable. And you can they're still up. You can still go there and read them.
Mm-hmm. Nice. What kind of sacrifices have you had to make in order to trade and be an entrepreneur? Have you sacrificed on sleep, time with family and friends?
I don't know how in Dutch it's called kluizenaar. So basically like locking myself up for multiple years. So when I dropped out of high school, all my friends were still at high school. they were studying, later they went to university, and I locked myself up into my parents' bedroom. Later on, I did move to a WeWork office before starting the fund, and then after a year, I got Munir, but I just locked myself up, and as a psychopath, I was trying stuff out, building stuff out, reading, listening to podcasts, watching YouTube videos, whatever I could to keep up with the space and try to earn a living out of it. Because I don't come from a lot of money, so for me, it was either get obsessed with it and master it as fast as possible to try and make it, or basically lose it all as in a time investment that I would not make it and could not make it my full-time job and would have to work as a cashier or whatever.
Mm-hmm. So do you end up having any free time to do anything else for relaxation?
In 2021, when I started launching the fund, because the legal work was going to take, originally it was going to take 3 to 4 months, but I got screwed over by my legal team, so it took over a year. But when I started setting up the fund, I decided to spend 3 months just hanging out with friends, etc., meeting them, eating out, etc. But I don't really regret it or anything like that. I really enjoy my life at the moment. I see many different kinds of people every week. I eat very good food. I have comfortable living, so I cannot really complain.
Great. Sounds like you're living the life, living the dream.
Well, some say that. I personally don't think so, but well.
Yeah. So in closing, what would you say to those risk-tolerant equity investors who are curious but scared of getting into crypto?
Take $100, experiment with DeFi, experiment on centralized exchanges, learn as much as possible. If you're young and you don't have the money to experiment, I mean, like, $10 on the Solana ecosystem, for example. Send me a DM on Twitter, and I'll send you $5 Solana where you can experiment with. Honestly, I would just say experiment with it, play around, compared to what it does to traditional finance. Join communities, ask questions. It's such an open space, and you're not really gonna lose anything except the money that you put in. Of course, you could always lose that, but just play around with it. That's what I would say. It's very open, it's very transparent, and there are a lot of resources out
to reach you.
My Twitter is at Casper Look, so Casper with a K and then LOOCK. I also have a LinkedIn, and if I'm not mistaken, Chat with Traders is also launching a platform where I can communicate with them.
Yes, we're launching a community.
So, well, I'll make an account on there, and they can also reach me on there.
Fantastic.
Stay tuned for the follow-up interview coming up right now.
So everyone, we're having this part 2 interview with Casper just 5 weeks after the first one, due to the extraordinary events that has recently rocked the crypto world. Last time we spoke, Bitcoin was around 20,000 and Ethereum was near 1,600. And just a week, 20,000 and Ethereum was near 1,600. And just a week later, prices had fallen 20 to 30% due to the collapse of the centralized exchange, FTX, run by the infamous Sam Bankman-Fried. Some are calling this the Lehman Brothers event for crypto. Casper, how have you been during these difficult times?
I've been pretty all right. I did have some significant exposure to FTX, but overall I'm doing well.
Did you have
some significant exposure to FTX, but overall I'm doing well.
Did you have an account with FTX or?
Yeah, I did have an account with FTX. I've been with them since the day that they launched. I really liked their product, and I was personally hit with my personal assets. I did move off a lot of my activity over the last few months since I had some issues with the exchange. But it's sad to see a player like that go, but it's also, eye-opening to see what kind of business that they were running.
Yeah. Can you describe for us what were the reasons for the collapse of FTX and its impacts on cryptos, NFTs, borrowing and lending, and decentralized finance?
So in short, what happened was you had FTX decentralized exchange, but Sam Bankman-Fried also had his own trading company called Alameda Research. and Alameda Research apparently went bust. And to cover that, what they did was they used customer assets to trade with their prop shop called Alameda Research. And that didn't really go too well. And they lended a lot of money to fill the hole on their balance sheet of FTX with their own tokens. So they were taking out loans against FTT, the FTX native token, against MAPS, against Oxy, against Serum, which were all very illiquid tokens and where they held the majority of the assets of. And a big exchange called Binance discovered that, and the CEO noticed this and decided to sell his shares of the FTT token, which caused the price to collapse. And well, all the lenders asking for their money back, and FTX couldn't provide that money because they lended it all out to their trading firm, which also lost all the money. So there was basically a bank run.
My understanding of FTX as a centralized exchange is regulated, right?
Yeah, they were regulated. You had FTX US and you had FTX.com. However, there were some malpractices going on, and it wasn't really a good oversight. And SBF was also one of the bigger sponsors, politicians in the USA, was really trying to push some bills. So everyone was trusting him on that end, while it wasn't really in check. They didn't even have a CFO apparently.
So after the FTX collapse here about almost a month ago, what were its impacts on cryptocurrencies, NFTs, borrowing and lending, and decentralized finance?
Well, borrowing and lending was already in a pretty bad state because there was uncollateralized lending was really popular. But after the Luna crash, because of players like 3 Arrows Capital, that industry wasn't already doing well because a lot of people realized, like, hey, a lot of these companies don't have their risks in check. So there, nothing major changed. Like some companies did go bust that had some loans open because they had a significant exposure to FTX. But the crypto market itself, the market pretty much nuked. Overall, there was 20-30% downturn on most coins. But coins that Alameda was heavily invested in or was active in had it really tough. Coins like Solana went from $30 to $9. Now it's currently back at 15. Their native token called FTT went from 30 to I think $1.5 right now. Tokens like Serum went from $2-3 to I think 20 cents at the moment. And that's still really high. Serum is their decentralized exchange token. So think of it as like a centralized order book on the blockchain, which was pretty new back then on the Solana ecosystem. That project has now been forked because a lot of the players that are building on that project realized that Alameda was only doing them more harm than good, and are now trying to build an alternative.
Mm-hmm. What about the big decentralized players like Uniswap, for example? Were they impacted significantly by this decline, or did some people argue that most of decentralized finance continued to work reasonably well despite the collapse of centralized player FTX?
Decentralized players were thriving at that moment because everyone was looking for alternatives, and especially decentralized alternatives, since they a lot of people had trust issues now with centralized exchanges. So players like Uniswap, GMX, Bird Protocols, Zeta Markets, etc., were all doing really well because of this. You can now also see that centralized players are feeling the heat and are feeling forced to show proof of reserves, so proof that they actually have all the assets that they claim they have on the exchange itself. But decentralized players are benefiting greatly from this, and you can also see that in volume.
Have any of the strategies you have been using been impacted?
Oh, yeah, definitely. FTX was one of the exchanges that I had implemented into my systems, and I really liked using FTX. It had a very clear UI. It had some very unique aspects like the non-USD collateral system. So you could use coins like Bitcoin, Ethereum, and others to trade certain assets with a certain float. So if I recall correctly, if you had $100,000 worth of Bitcoin, it was calculated as $95,000 that you could use as collateral to trade perpetuals. And that was something really nice especially for hedging, etc. It was a big deal to me. Their funding rate system was also very interesting. Most exchanges pay out a funding rate every 8 hours. FTX did it every hour. And well, they just had a very simple and clean API and user interface. They were also one of the few exchanges that supports fixed API, which is important to market makers. Not something that I use personally, but a lot of my friends are missing that, on FTX and other exchanges.
That's a shame that all this happened. So are there any other centralized players that come close to making up for the collapse of FTX? Can you do your strategies through Binance, for example?
Yeah, I mean, most of my strategies I can run on other exchanges. I've personally integrated with 4 other exchanges, and I've now integrated Coinbase too. To make up for for what I'm missing at FTX. But you can definitely run these strategies on other exchanges too. But it's you're definitely missing one of your major key components in your systems. Especially, I like to use FTX for directional trading because you had that hourly funding rate. Liquidity wasn't always too great on FTX, but it was a very good user experience. And I had very low fees there. I had a good connection with the team. So if I had ever any issues, I just contacted them directly, which is not something that I have with every exchange. I have it with Binance, I have it with Bybit. But exchanges like Coinbase, they demand a lot more volume every month before you can get to a level like that.
In the last month, have many other players left the space, creating potentially more opportunity or less opportunity for you?
For me personally, there's a lot more opportunity at the moment since Alameda was one of the biggest players in this space and also a bad player in a lot of ways, which is now removed. There are a lot of trading firms that are down or simply closed their doors. Are now rumors going about Amber Group. The CEO recently died. That they aren't paying their workers and that the seniors are missing. So there's now definitely a gap for traders like me, which I'll definitely take advantage of.
Have you experimented with any new strategies since the last time we talked, or are the strategies that you have been using, you're saying they're creating more opportunity now because of the exit of some players?
I'm not really running any new strategies. I've simply, first 2 weeks after at the FTX stuff happened, my focus was simply, okay, what is currently going on with FTX? Is there any chance that I will be getting my money back? Quickly realized that wasn't the case. Removed FTX from my systems. Checked if there were any errors caused because of it to see later on if there's another exchange that is having issues the same way that FTX caused it. Will that interfere with my systems? Wasn't really the case. Besides that, I've been busy developing some stuff and looking at some new arbitrage opportunities, but I haven't executed them. I think I'll be doing some live tests the 8th of December, but I still have to wait a little bit for getting some more data.
Leverage has been a big topic in the crypto universe. How often do you use leverage in your strategies?
Leverage, to me, I use it if I don't have enough collateral on a specific exchange, but I have it somewhere else. So let's say I want to create a long position on KuCoin, but I only have 100K there, but I want to create a 200K position. I don't mind using 2x leverage to enter that position and then move 100K capital from, let's say, Binance to KuCoin. But for a lot of players, they simply use leverage to get naked into a position to create more exposure. Besides that, a lot of people use it to limit their exposure to a specific centralized exchange. So in the case of, let's say, FTX, I knew a lot of my friends only had 10% of their capital there, even though that it was their main exchange. And then they simply use 10x leverage to trade that specific asset that they wanted to do while having their counterparty risk limited.
So there's been a lot of horrifically negative sentiment in the news today, in recent days and weeks, regarding crypto. Last week, the European Central Bank said that crypto is on the road to irrelevance because Bitcoin is rarely used for legal transactions. Its impending regulation is misunderstood as approval, and its promotion bears reputation risk for banks. Bitcoin transactions are cumbersome, slow, expensive, and have never been used for any significant extent for legal world transactions. Any thoughts on that statement? Why do you think they want to make that statement if it's on the road to irrelevance?
I find it strange that they make that statement because I have a few friends that work at the European government and work at some financial companies there. And what they're telling me is that, for example, the central bank and some financial institutions from the government are giving out DeFi lessons, so how to work with decentralized finance. And that that you're looking for a lot of crypto native people at the moment. I know that they're trying to improve their laws by 2023, which I think is going to be delayed to 2024. There was recently also a new law that they wanted to implement around stable coins, that you're limited to. It was something related to like USD stable coins versus Euro stable coins, but I can't really remember what it exactly was. And when it comes to Bitcoin still gets used for legit transactions. The thing is, if you see a transaction on the blockchain, it's very hard to know if it's for a legal use case or illegal use case unless you know one of these addresses that is related to a specific crime. I personally use Bitcoin to pay for stuff sometimes, like gift cards, etc. Or if I have to pay, for something online in general, because my credit card is acting up because it's, it's a strange country that I'm buying something from, even though it's just an online subscription or whatever. For me, cryptocurrency is overall easier to use. For Bitcoin itself, it's hard to really say because I don't really use Bitcoin that much anymore. I'm more of an Ethereum and Solana guy, because it's faster and you can interact with smart contracts, etc. But the statement doesn't really make sense. But it's also logical that you're going to talk badly about a competitor like that.
Do you think that it's much better to talk about the specifics, the pros and cons of each type of cryptocurrency, instead of just lumping it all into one basket?
It's kind of difficult to say because I'm really pro crypto, but on the other hand, if I was in their shoes and I would have to address the public, the average Joe, I would not advise the average Joe to get into crypto simply because there are so many scams and so much can go wrong, and it's more for for tech native people to get into, or for investors that are looking to really speculate on certain markets. So if I were in their shoes, maybe I would also make a statement like that, not really saying that it's fully irrelevant, but give more warning signs, try to get people to stay away from it unless they really know what they're doing. But saying that it's irrelevant, isn't really a valid opinion. If you're giving out DeFi lessons, etc., and are looking for crypto native people to work for you, that means that it's definitely here to stay. I don't know. It's the banks make so many strange statements all the time, and I didn't really follow it up over the last few weeks, what they exactly said. So it's hard to give an opinion about it.
Some people are saying that there's some talk on the regulatory front that exchanges would make users pass a test before they could enter DeFi, so that they have basic understanding of the risks that are potential in DeFi. Would you support that kind of regulation?
Depends on how far it goes there. I don't really know how they want to implement it. Like, do they want to implement it in the user interface of a website? Like, let's say that I have to go to Uniswap, that I have to fill in a quiz before I can actually use the protocol. I find that a little bit hard to implement, since how are you going to check if this person already did a test? Are you going to link it to a certain wallet? But then you have to somewhere store that information. Are you going to log it by IP address? There are so many questions around it that I find pretty difficult. I would rather not see it happening, but I wouldn't be surprised if it would, because you already have it with some cases like futures tradings and perpetuals trading. If you go to Binance and you create an account there, before you can trade futures, you have to fill in a quiz. So I wouldn't find it strange if certain protocols, if you use their user interface online, like GMX, would actually ask you like, hey, this is how our systems work. Are you aware of that? What the risks are, etc., etc. I would find that kind of logical, but on the other hand, it's a decentralized protocol, so you cannot really, there aren't really any laws when it comes to crypto itself. I think it's very hard to implement, especially because are you going to do it in user interface? But if someone forks that interface and then just removes that quiz, how are you going to stop it? It's kind of like saying we're going to force you to do a quiz before you can use a cryptocurrency wallet. It's all open source, so someone can just fork it and remove it without an issue.
Mm-hmm.
So someone can just fork it and remove it without an issue.
Mm-hmm. Yeah. So turning to sentiment, right now there's so much negative sentiment regarding crypto, and some prominent people in the investment field are saying, sell all your crypto. For example, James Cramer, the head on CNBC, is saying, sell all your crypto. And recently we had a front cover article on The Economist saying, the downfall of crypto. Do you ever look at contrarian indicators like this as possible early indicators of we're getting near the bottom?
Well, if you look at Jim Cramer, his tweets, and you put them on the Bitcoin chart, then it always does the exact opposite of what he says is going to happen. So I'm very happy that he is bearish on cryptocurrencies, and I hope he remains like that for a couple of years. When it comes to The Economist, the downfall of crypto, everything that has happened is actually just an indication that there is actually need for crypto, because cryptocurrency is all about decentralization, transparency, and being open. The reason that we use centralized exchanges is just because the liquidity currently on decentralized exchanges is pretty bad. It's pretty slow, and there are some privacy concerns when it comes to a wallet address. You can look into it, you can see what kind of positions it has, open orders, etc. on a decentralized exchange. However, on a centralized exchange, you don't really have that case. However, you do lack all the aspect of it's a centralized party. You don't really know where your money gets placed. This is just a sign that we actually need to work more on decentralized exchanges and bring those really forward. And I think it only shows that we really need crypto more than ever. Saying that it's a downfall of crypto, I think is a very bad sentence to say. I would say it's a downfall of SBF more than anything.
Given the blowups that we've seen with FTX, Celsius, Voyager, and others, how do we improve the crypto ecosystem to increase stability and trust in the centralized and or decentralized exchanges?
Well, when it comes to centralized exchanges, I think stuff like proof of reserves and just having a good auditor, maybe having multiple auditing firms that are doing regular checkups would be something nice to see. FTX apparently did do audits, but only once a year, and there were higher ups that could tamper. Apparently SBF had some kind of backdoor into the accounting system that the CTO Gary made for him. So that is fairly hard to spot, but I think if we have more regular audits from multiple accounting firms, that would be something very nice. Having stuff like proof of reserves would be very important. And when it comes to players like Celsius and Voyager, the suspicious thing about these players is that you don't really know where the yield is coming from. They were promising yields of 10 to 20% on stablecoins, which is utterly insane. And people didn't know where it was coming from, apparently from big players like Three Arrows Capital. But I think if you provide some kind of yield on a centralized exchange, I think it's very important that you know who your counterparties are. With players, like Binance, etc. If you want to lend out your money, you know who the counterparty is. It's another trader that has collateral on Binance and will get liquidated if he's not able to pay that back. However, with players like Celsius and Voyager, you simply don't know who that is. And it's very hard to calculate your risk if you don't know that.
Mm-hmm. Yeah, so there's been some positive movement toward releasing proof of reserves, but the critics argue that, well, what about the proof of liabilities? Because unless you know what the liabilities are, that showing your proof of reserves is only half the picture.
Yeah, I fully agree with that. But when we're talking about proof of reserves, I just mean like the assets, the assets that they have, and the liabilities, of course, as is what they owe to users, etc. But I personally don't know how they're going to approach that problem. I personally haven't, been too deep into it yet on how they could actually build a solid system around that. So I cannot really go further into that.
What are your thoughts about whether we need a decentralized algorithmic stablecoin, such as an alternative option to the centralized government-influenced stablecoins like USDC and USDT? Supposedly, Aave is designing a stablecoin called Go. That's algorithmic. What are your thoughts on all of that?
I try to avoid algorithmic stablecoins as much as possible. I mean, we've had some tries in the past. It's true that Aave and Curve are both now building some kind of stablecoin, but they released some kind of light paper, but I haven't really, dig too deeply into it. But I personally don't really have an issue with centralized stablecoins as we have it right now. I think coins like BUSD, USDC from Circle, USDT from Tether, they're working fine as is. You already have some kind of algorithmic stablecoins that are working, like DAI has been a very strong contestant. You also have UXD, which is a stablecoin on Solana that I find very interesting. So what they're doing is create a stablecoin, but it's backed by delta neutral positions. So they would go long Ethereum somewhere and short it somewhere else, do a potentially cross-funding arbitrage or something like that. And those positions would then be the collateral for those stablecoins. But when it comes to the Curve stablecoin and the Aave stablecoin, I haven't read the documents yet.
In Europe, do they have certain disclosure requirements regarding the use of leverage? When and how much and to what degree?
It depends. I'm limited to my usage in Luxembourg, but how it is with me is in my offering document, I stated how I exactly use leverage. I go into the types of strategies that I use, how I use them, the risks that are involved. I personally just put the risks of everything to the max because I didn't want to fiddle around with how riskful is it really. I just put the risk on the highest. I explained how I use leverage. And when it comes to providing proof that I actually have these assets, I have to go to my CPA every quarter to do a NAV calculation, and they go over every single order, every single transfer, every single payment I have done, individually to actually do these calculations, and then they make up the final document that I can send to my investors saying if their share prices are up or not. I don't really know how it works in places like Cayman, etc. So it's hard to form an opinion on that. My system is at least very transparent, and that's a good thing, especially now, since a lot of players didn't care about that 2 months ago.
For a part 2 catch up, Casper.
Thank you.
Great.
You've reached the end of this episode of Chat with Trader. There are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 20 stocks. Options is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
Markets, speculation, and risk. This is the Chat with Traders podcast.
This is episode 252, and I'm Tessa, co-host of Chat with Traders. If it's a statistical fact that most traders fail at trading and that trading psychology is a very big part of trading successfully, why don't we pay more attention to this aspect of trading? But even if we understood why we get in our own way in trading, would we even do what it takes to get out of our own way? Or do we continue to hang on to what doesn't work out of mindlessness, habit, comfort, and ignore the need to do the uncomfortable and real work that requires patience and practice? Perhaps we ignore doing the deep work because instant results are more appealing. Or if we do the deep work, we would have to face our demons. Today, Ian and I present to you a very special guest. His name is Ivan Bayaji. Growing up poor with learning difficulties, Ivan's early trading failures drove him to understand his own emotional turbulence and instability in the mind through deep inner work. With a heightened sense of mindfulness, he embraced uncertainty and became systematic in his trading that contributed to his edge. Ivan discovered trading in the 90s and has been trading for a living since 2006. He struggled and failed his way to achieving consistency and market success over time. He's the man responsible for the creation of Trading Composure, where he generously shares with traders all over the world his knowledge, experiences, and wisdom of the inner game of trading. Ladies and gentlemen, coming to you all the way from Montreal, Canada, we present Ivan Bayaji.
So diving into the world of financial investments and trading, if you could take us back to when you were younger, how old were you when you first got into the stock market?
So first of all, despite my youthful looks, Ian, I'm a seasoned trader with 20 plus years of experience in financial markets. And I don't have a glorious background pre-trading. I was raised by a single mother and, we were very poor. She had 4 of us at the time and didn't work. So we lived on welfare, food stamps, and all of that. Since I didn't do well at school because
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers open the doors. The market reinvents itself. Online brokers open the doors. Mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
You know, there's a funny thing where people say to me, "Oh, you're a quant. You're not creative. You know, other people are creative, but people like you just like numbers." And it's like, well, no, because the numbers just answer the question, but your creativity comes up with the question, right? You have to sit in, but your creativity comes up with the question, right? You have to sit there and look at markets and look at things happening and say, I feel there's a thing that's happening here. I wonder if there's an advantage, but all of the money comes from
markets, speculation, and risk. This is the Chat with Traders podcast.
This is episode 253. I'm Tessa, co-host of Chat with Traders. You just heard a little snippet of our guest today, who I will introduce shortly. I hope everyone's doing well, staying healthy, or at least trying to stay healthy. And it's amazing that we're already in February. If you're a new listener, welcome to Chat with Traders. And for all of you who've been longtime listeners, we appreciate you so much. We have listeners from all over the world, and we'd love to hear from you. We literally want to hear your voices. Simply hop on the chatwithtraders.com website and click on the Speak to Chat with Traders in the menu, state your first name, where you're calling from, and answer the question, what keeps you in the game of trading? Keep it short and brief, and if we get enough voices, we may compile it and share it with everyone. Well, I'm excited about today's show. Ian speaks with another very special guest of ours. His name is Patrick Boyle. Patrick is a finance professor, author, quant hedge fund manager, and a connoisseur of financial history. As a young investor in utility stocks, Patrick's hunger to learn and apply the lessons of financial history helped him to maintain composure during the frenzied bubble market in the late 90s. His studiousness and growing aptitude for finding opportunities resulted in him making valuable connections with mentors and business partners. His desire to understand history by analyzing data led to building quantitative trading models, and eventually he launched a quant hedge fund called Palomar Capital. Guys and gals, this episode is jam-packed with so much rich information, wisdom, humor. Patrick is a natural and engaging storyteller, and he makes finance that much more fun. Ladies and gentlemen, we have the great honor of presenting Mr. Patrick Boyle.
Well, Patrick, welcome to Chat with Traders.
Thanks for having me. It's exciting to be on.
Yeah. So a little bit about your background. Where did you grow up?
I was born in the United States, but grew up in Ireland. Both of my parents were Irish. And so, I went to school in Ireland. I guess we moved there when I was about 4 years old, and I stayed there through university, and then came to the United States to work afterwards. So.
Oh, great. What did you major in university?
I studied business for my undergrad, and then later I went back and studied finance as a master's degree. So it's kind of interesting because initially I didn't really know very much about markets. And so, when I started working in the world of finance, I kind of knew more the kinds of stuff you learn in a business degree than a finance degree. So I kind of knew all of this sort of accounting type stuff, but nothing about kind of how markets work or, stocks and bonds or why people buy them or anything like that. So,
so was it your So was it your experience in the university that helped trigger your interest in the stock market or commodities market or whatever, or was it friends or family?
It was possibly, I guess my dad, when I was a teenager, I've sort of worked summer jobs since I was 14, which was when I was allowed to work. And so I worked for one summer and earned, kind of saved all my money at the end of the summer at the age of 14. And my dad then encouraged me to invest it in the stock market. So I bought a stock. And at the time I was terrified, that I would lose all of my hard-earned money. And basically kind of summer by summer I would work, and my dad would encourage me to invest some of the money. But in truth, like I really just sort of listened to what, like I picked these, I think the first stock I bought was, I forget even, it was some sort of utility company. There was, some special, tax treatment to utilities at the time. I don't even remember the reasoning at all because I was 14 years old. But it kind of, it kind of got, it sort of interested me. But even at that point, I worried quite a lot about it because I felt I worked very hard. I worked very hard to save money, these kind of minimum wage jobs you get as a teenager. And the last thing, you see the stock fall a couple of percent, you see the stock fall a couple of percent and you're like, well, that's hours of work gone down the drain. So, yeah.
Yeah. So you started off as like a buy and hold investor was that the early 90s?
Yeah, exactly. Yeah. And, really just kind of, essentially it depended on how much I would earn over a summer, but I would buy kind of one or two stocks with my savings. And, back then commissions were very high. So you really did just buy and hold. And in truth, I kind of, overall, even though I'm a reasonably fast-paced trader, I kind of still recommend to most people that buy and hold probably works for them. It's sort of, you get exposure to business works for them. It's sort of, you get exposure to business, to owning a business and the sort of returns that come from that.
Mm-hmm. And over this time period, you got started when you're a teenager. What sort of things did you kind of look at when picking a stock, or did you just pick a stock because maybe your parents recommended it, or you?
It was very much like my dad, and my dad was a doctor. So my dad, I think, had a broker, and he would go in and have these long discussions with his broker. And then it was, it was really very directed by my dad. Like it's one of those things where he'd sort of give me a choice, but it was, it was pretty much, I think the idea was just to sort of diversify and to buy kind of safe companies and that kind of thing. But I can't really, be a total lie to claim that there was any real wisdom that occurred at that point. It was very much, I think, my dad just sort of wanted to encourage me to save rather than to spend my money. And my dad had invested for years, and, it just sort of seemed like a reasonable thing to do. So in truth, it was probably, the overall goal was probably just diversification. There were no, I don't really believe there would have been mutual funds, but I had single stocks at the time, and there were no index funds or anything like that at the time, at least not commonly available. And so just sort of every summer I would work and buy sort of a stock or two. And by the time I guess I was in my 20s, I had a little portfolio, and there'd been a bit of a bull market, so it had done reasonably well.
Mm-hmm. And how did the advent of the internet and the dot-com boom, come into your investing experience?
Well, the dot-com boom kind of had a huge effect on me because I started working in the markets in 1998, so kind of right as things took off. And back then, I worked in the private wealth management area of a bank. And, it went from like the stock market being sort of a thing that sort of a few people invested in to being, sort of a constant discussion. Like every time you went out to a party or to a dinner or whatever, people would be talking about stocks. And in particular, they'd be talking about the kind of high-flying internet stocks at the time. And so that was a very interesting point to start in the market where there's sort of a boom and a bust, and it's interesting because I worked in the long only private wealth management area, 98, 99, 2000. And then 2001, kind of right as well, 2000 the market started to fall. And 2001, when people were, starting to really lose faith in markets, was when I started working at a hedge fund. And so that was when there were sort of more opportunities to go long and go short and kind of short-term trading and all of that sort of thing. And so it was kind of quite an interesting, I guess, just the timing of all of those moves and everything was quite interesting. I think I even started work around the time of the meltdown of long-term capital management, so I sort of turned up at work and like things were as 1998 was actually a hugely volatile year. Like, there were kind of daily swings. There were big swings. And then 1999, it was like the tech stuff that all just went straight up. And of course, being a young guy and kind of understanding the internet, like I would have kind of had my own computer and been an early adopter of the internet and kind of, had things like internet banking and, been on, buying stuff on eBay and things like that. Like I was quite excited by the .com, by the internet on its own and by computers. And then also all of these stocks that sort of seemed, what can I say? It was a time when older investors were sort of viewed as possibly a bit out of touch. It didn't turn out that they were, but there was a good year and a half there where if you were young and you kind of felt that you knew all of the cool startups and whatever, and you had no concept of valuation, but sort of a knowledge of what was happening, like what was cool and what was not. You seemed very smart for about 12 months, and then people started avoiding.
So did you buy into the idea that this bull market in the .com era was different from other bull markets because of this revolutionary technology called the internet was going to usher in a new golden age? And so it would be justified having high expectations of what stocks could do.
I kind of did, in that it's interesting because I remember at the time feeling that it was very reasonable to expect, we'll say 20% returns, right? So when I would invest, I would put my money in the market and sort of calculate sort of how much money I would have in 10 years' time, compounding at 20% a year. And that, like, it sounds idiotic today, but back then, it's sort of like that's sort of all of the friends I had and everything thought like that. Now, I was lucky because I worked in the business and I worked with sort of smarter, older people who had seen things a little bit more. So they would kind of give more sensible advice. I think I got more excited by the idea of it, but because I already had kind of a diversified portfolio of stocks, and I was really at that point, I was investing sort of new earnings and kind of dividends that would accumulate would get reinvested. But I was lucky not to really get too caught up in the real nonsense, largely because I had sort of smart people around me who would sort of say, let's watch and see how this works out. But I was kind of a believer. It's a funny thing because in the last few years, like young people, sort of the same people as me, but, today have been quite caught up in a lot of the crypto stuff and things like that. And, I have a lot of sympathy for that way of thinking because that's how I thought at that age as well. But the thing I would say was that it was very obvious as a young person with a computer back then that the world was changing. There was a way that I could do stuff, like I could buy stuff on the internet, I could email my CV when I was applying for jobs. All these kinds of things existed that people my parents' age didn't understand, but they were definitely better ways of doing things. And so the business case behind the internet, the idea that things like almost the knowing what wouldn't work was useful because it was at the time. I remember there were a number of IPOs for like Yellow Pages and things like that. And I remember as a, sort of 22-year-old kind of looking at this and thinking like, who on earth is going to use a phone book? Like it's sort of it arrives at your home and you recycle it. But those things were going public, and I kind of wonder if the management of those companies knew that it was on the way out. Well, I think if they had known, they probably would have found a way of banging it up on the internet. But I think there were certain things, like there were obviously businesses at threat from the internet. And I think that part of the equation was correct. But the other side of the coin, where you looked around and you saw all of these kind of hot new startups, and you'd read in the newspaper that some guy launched a website and a week later was a billionaire. And I think I was too young to be grounded enough to realize that was nonsense, like that it didn't make sense, and that the multiples, back then, a lot of those stocks, because they were sort of so ridiculously expensive, the brokers came up with different ways of, they'd say, oh, well, you can't look at the price to earnings ratio because the earnings are negative. But we've come up with the price to clicks ratio, because the amount of people who click on this website means that it's a hot website. And you kind of go, well, yeah, I can see how that's a good way of separating the different websites, but it's a bit unnerving that none of them are making money, And so I was kind of intellectually caught up in it, but I was possibly a little bit lucky that I didn't throw too much money at it. Like I kind of stewed on it long enough to kind of not make. I did buy one mutual fund at the absolute top, but luckily with not much money. There was one called like the Janus Technology Fund, and I really believe I bought it in towards the end of December in 1999. And luckily, I think I only put a couple of $1,000s into it, but I think that was the high tick of that thing. Like it just went straight down. And I remember reading all the news articles about the guy who ran the fund, and they kind of go, he's a genius. And they'd have pictures of him like climbing down a manhole, inspecting the fiber optic cables that were being put under the ground. And like, he really understands this stuff. And you're like, well, good. He'll know if this is all falling apart. And it's like, he didn't. That thing wrapped up about a year later.
Wow. Did the overvaluations in any of these .com stocks tempt you to sell short?
I didn't know much about short selling at the top. And then by the time I started kind of really actively trading, I was trading futures and trading kind of index type futures. So I kind of, and really what happened actually to move me, because the truth was I was one of the things that interested me about markets was just companies. Like I was interested in companies, what they do, what's the difference between a good and a bad company, that sort of thing, like kind of the kind of thing someone interested in fundamentals would be interested in. But I worked in this sort of wealth management area where we were, very much long-term investors. And it was also, the people I worked with were all kind of quite a bit older than me. They were the youngest people like managing money were in their 40s. And I was sort of a rather fresh-faced 20-year-old with a big mop of hair. It's quite a different look back then. And, of course, they wouldn't put me in front of a customer because I was way too young to be put in front of a customer. But I was young enough to also think that they should put me in front of customers. So I figured that what I needed to do was to have experience, right? Because the real thing these guys had is they were able to say, well, in the 70s, when this happened, this was a good investment approach. And so that's what we're doing. And I thought, well, how can I understand all of that stuff? Like, how can I understand stock market history? And so there were two approaches. One was just to read books, and luckily in the late 90s, Barnes and Noble was packed full of investment books. Like it was half of the bookstore at the time. So there were lots of books to read. And then I just thought, well, in order to understand like kind of how the prices move and the history of like what worked and what didn't and when did it work, at the time there was all this data on the internet. And amusingly, it was easier back then to get stock market data than it is today because all of those .com companies just threw a load of data up on the internet, so you could download all of this stuff for free and start, kind of screening or analyzing it. And so I started just downloading data and trying to understand, like, in a rising interest rate environment, how do stocks perform? Which stocks perform? In a falling interest rate environment, how do stocks perform and which ones perform? Should you buy high or low PE companies? Should you buy value stocks or growth stocks? And and when do these various things work? And so I just started building. I had moved to Boston and I didn't really know anyone. I had one friend in Boston and a computer in a small apartment. And so I just spent a lot of my spare time. It was a way of learning how to use the computer, and it just interested me. And so I would just analyze all of the data. But I was looking for long-term, long-only investment strategies, like something that would say to me, in this economic environment, you can buy this type of stock and hold it indefinitely, and you should outperform. And the funny thing was that I found things that were sort of reasonably interesting like that, but I kept finding kind of more short-term stuff. And that was entirely unsuited to what I was doing at work. So I was sort of able to look smart in the office because I'd go into the office and sort of discuss the backwardation in the oil contracts. And people kind of go, oh, how do you know about that? Yeah. But, I'm not sure that it added a lot of value from the oil contracts. And people kind of go, oh, how do you know about that? Yeah. But, I'm not sure that it added a lot of value for my employer. But that sort of pulled me towards the trading thing, simply because I worked out that even though I wasn't trying to find short-term signals, analyzing data tends to dig out shorter term rather than long-term signals. So that was kind of what happened with me.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So it sounds like on your own accord, you had a natural interest in getting into some kind of quantitative trading on your own. Is that accurate, or were you introduced to it by someone else?
And I came across like this idea that you could understand history by analyzing data, but I wasn't very good at analyzing data early on. Like, I didn't really know enough of the sort of statistical techniques. So I built all of these models and tried to understand things. But it was really when I read Vic Niederhoffer's book, Education of the Speculator, And I read this book and I was like, oh, this guy he's got similar ideas to me, but he's way, 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 way better than me. He's way smarter than me. And so I kind of dug through his book. I have about 5 copies of that book kicking around the house. But I have my original copy that's all worn out from reading it and rereading it. But that book, and then there were also things like the Jack Schwager Market Wizards books that I read. And, at the time, I was reading the Jack Schwager book and I didn't really know what futures were, so I had to learn all of that stuff as well, because I was used to just single stocks and bonds. And basically, I kind of worked out that there was a world of people who sort of thought like I did. And then I met with Vic Niederhofer, and he would just critique the sort of analysis I did. I would do these awful studies and send them to him, and he'd kind of go you're going in an interesting direction, but you don't understand how to differentiate sort of randomness from a real market effect. And so he would email back and forth with me and sort of tell me what I was doing wrong, and I slowly got better. And so it was, I guess, a combination of curiosity. I think also I think one of the good things about me at that point in time was I was quite aware that I knew nothing, and I think that that's a good way to be. There's a lot of people who know nothing and they think they know everything, while I very much it was the realization that I knew nothing that made me try and learn this stuff. And then as I learned stuff, you'd find these little things and you'd be like, gosh, I found something really interesting and other people don't seem to know this. And that, of course, just encouraged further research. But my research, to be honest, was not that good. There were things I got interested in. My research, to be honest, was not that good. There were things I got interested in, like closed-end mutual funds. When I worked out that some of them traded at discounts and some at premiums, I then wanted to see, well, what happens if you buy all the ones that are trading at a discount, or what happens if you buy those and sell the other one short? And of course, I wasn't even able to trade this, but I just wanted to know what happens. And basically, I just, kind of just possibly out of not knowing very many people and having a computer, I kept myself busy learning all of this stuff for a few years. So.
Oh, wow. And so what did you find with that closed-end mutual fund strategy of buying the discounted ones and shorting the ones with premium?
It was an all right trade that earned very little money. And actually, that was one of the real benefits of meeting Vic Niederhofer, because he would point out to me, he'd say to me, Patrick, you keep finding a bunch of things that work as long as you don't include transaction costs in them, And the minute you throw transaction costs in, these things are all money losers. Like you said, you're thinking in the right direction, but you've got to find these things are all money losers. Like you said, you're thinking in the right direction, but you've got to find fatter profits that compensate you for risk and that compensate you, and that will overcome the cost of trading, so compensate you, and that will overcome the cost of trading, so things like that. And then just actual statistical methods that Victor would he'd recommend all of these books to me, and I would get the books and I'd dig through them and I'd say, well, what does this mean? How should I use this? And he was very generous, because Victor was, he was kind of quite a serious guy, and he would answer my emails, and that was kind of quite exciting, and it was really good for me.
Wow. I understand. Did you later go on to work with Victor?
Yeah, about a year after reading his book, Victor, I was working at Bank of America at the time, and I just bought my first apartment. And Victor sent me an email and said, do you want to come out to Connecticut and work here? And I kind of almost didn't, I wasn't entirely sure if he was serious or kind of teasing me. And I said I would. And I think I drove out to meet with him. He made me a job offer. And I moved, 2 weeks later, I gave 2 weeks notice to Bank of America, rented out my apartment and moved to Connecticut. Because like I couldn't believe my luck. Like, a year ago I had read his book. It was, in my opinion, the best. To this day, I think it's one of the best books on sort of what can I say, like how a trader thinks. And to kind of, a year later be sitting in that office, it seemed amazing. To this day, it seems amazing to me. Like it really was quite a stroke of luck.
Wow. Was he a catalyst for you to start your own quant hedge fund?
I don't really know. I loved working for Victor, and I actually loved working. I liked. I don't know that I'm like necessarily the world's most entrepreneurial person. I enjoyed working basically everywhere I worked. I had this great luck that I met a ton of really smart people. Like just at almost every firm I've worked at, I've really enjoyed it. But what happened, the real reason I launched Palomar when was it? It was in 2011. Basically, the credit crunch had ended, and there was kind of I guess just to cut back a little bit, I would say that I spent many years as a trader, and I was never, because once you take this sort of statistical approach, you're always trying to separate randomness from reality. So just because you've had a good run doesn't mean you're good at what you're doing, right? You could be lucky flipping coins or whatever it might be. And so I spent many years kind of agonizing over, just because I've made a profit doesn't mean that what I'm doing is any good. It could just be lucky, or I could be making money, but I'm exposed to a risk that I don't understand. I had kind of, I was a big fan of the Lowenstein book about long-term capital management, and there's a huge warning in there to any trader that basically says, don't start thinking you're too smart, because just because something's worked for a few years and it's kind of new, it doesn't actually mean that it's a good idea. And some of the tests I had run, you would find these trading strategies that would win like 90% of the time. And you'd be like, well, that's amazing. But as you run it on more and more data, you see that it does win 90% of the time, but that 10%, it will lose you way more than it made you when you were right. And so any good trade that you have, you're always wondering, is the sword of Damocles above my head? Like, am I right? And so I always had and kind of still have a certain amount of doubt about, like, when things go well, I never get overly excited. And it was really that the credit crunch had ended. And during the credit crunch, I had seen a lot of very smart people really fall on their faces, like good people who had been good traders for a long time. And when the market collapsed the way it did collapse, they had, a year that had lost more money than they had made in the prior decade kind of thing. There are a lot of people like that. And I had managed to kind of grind out a sort of a reasonably low volatility, decent return during that period. And then what had happened was just, I'd worked at a couple of banks in London where, there were prop desks where it was basically an internal hedge fund within these banks, and they would pay you as if it was a hedge fund, and it was great. And you'd get to use all the infrastructure of the bank, and it was a wonderful job. But because of the credit crunch, the banks had basically all become semi-nationalized. They're under government control in one way or another. And they were told they had to de-risk. And none of the bank, even though it entertains me, because the real losses in the credit crunch came from basically the traditional business of banks, which is lending people money to buy houses. But anyhow, they decided they had to de-risk, and there was no bank CEO that was going to sort of be hauled in front of Congress to explain why a bunch of fast-paced traders in a quiet room in London had blown a load of money. And so the banks were really losing the will to hire people like me. A lot of the big hedge funds, they were kind of doing okay, but it seemed to me that there was a real risk. Like I'd seen a few people who had, done all right, but they'd kind of hopped around a few jobs, and I didn't want to do that. And I kind of thought, well, if I launch a fund, and even if I just have 5 customers, that's like 5 jobs. It's diversification, right? And if one of them, doesn't like what I'm doing, well, the other 4 might stick around. And so really kind of the reason I started a business was just that it seemed like the only way to keep doing what I was doing at that point. The idea of working at a big firm and not having to spend your time on many of the other issues, because running a business is very different to running a trading strategy, and that is the downside of running. Well, at least if you really love trading, the downside of running a business is that you suddenly find yourself involved in all sorts of IT issues and capital raising and marketing and all of these other things that weren't necessarily how you wanted to spend your time.
Mm-hmm. If you wouldn't mind sharing with us, what was your biggest loss and how did it all happen?
My biggest loss was a bit of an interesting one, or like I don't know if it was biggest percentage wise, but the worst day of trading I ever had was the day of Jerome Kerviel's. When the rogue trader. It was actually around this time in 2007. It was kind of right before the credit crunch. The markets were closed because it was Martin Luther King Day. And at SocGen, they discovered that a rogue trader had, I think, bought like 30 yards of Eurostoxx futures. And they decided to bang that all out on a day when the US markets were closed. And so it was expected to be I worked in London at the time. And on those days when the US market is closed, the European markets are open and nothing much happens in them. It's a bit of a sleepy day. So I turned up in the office kind of in jeans, which was not the usual thing, but I was basically kind of, high-fiving the boss and then heading out again, high-fiving the boss and then heading out again kind of thing. And the market was collapsing, and I had a lot of signals that said to me that the market should go up. And so I took a decent sized position, and the market just would collapse, stabilize, collapse. And eventually the S&Ps seemed to calm down. And that was when I realized they were limit down. That's why it stopped falling. It was the first limit down day I had seen in markets. And it was sort of an interesting thing because that was a brutal day, like where, I just couldn't have been more wrong. And, was trying to get out and trying to cut size. But no matter how much you cut size, the fact that the market was like it was crashing, there's all you can do is look less awful. If you came into this long, it's just sort of risk management and trying to get out. But fortunately, there was when I had about flattened out with just a brutal loss, like just I felt humiliated. I'd stand there in a pair of jeans with the worst losing day I'd ever had, explaining that to senior management. And the Mark Bernanke had, it had been so awful that they did that emergency rate cut. So the market started taking off, and my signal said, you've got to get this again, because there's sort of a point at which you think like, I need to just go home and go to bed. Like I need to stop with this. And so anyhow, it also like P&L, amusingly, the P&L didn't get struck on my loss because the market was closed. It got averaged over 2 days, and I managed to make enough money on the bounce back that in truth, like if you look at my P&L as calculated by the systems, it looks like an all right day. That is a day that I will remember as the worst day I've seen in markets. But it turned out to be kind of a good thing for me, because that was right before the credit crunch, and we had been in an awfully low vol market. The S&Ps used to back then, they'd have a daily range of 4 points, and fortunately that big volatility explosion, you know, led me to adjusting size, adjusting risk management, because my systematic approach to trading is quite dynamic and pulls in what's happened recently. And so when the whole credit crunch kind of kicked off, I felt very lucky to have sort of been almost immunized from the fear of the volatility because of that brutal day that had happened maybe, you know, a month or so before the real horrors of the credit crunch appeared.
How has your experience with the limitations of quant trading varied over the years?
The limitations. Well, you know, the interesting thing, you know, I guess everything you do limits you in one way or another. And it's a funny thing because as a quant trader, as I said to you earlier, I kind of always loved the story of the market, and I still love the story of the market, and I love reading all of the news that I don't then trade on because that's not what I do. And so in certain ways, you're kind of limited by that. But one of the thing that I really enjoy about quant trading is the fast-paced nature of it. Now, the fast-paced nature equally means that you kind of grind out a whole bunch of small profits that hopefully turn into a large profit over time. But you never have like a heroic story of like sort of buying a stock that 10x's or whatever, you know, because you're just in and out constantly. One of the things that I like about it, and one of the fact that you trade a lot means that you really examine yourself, like you really examine your own decision-making ability. And I think that that's actually the thing that has kept me really interested in markets, because in a funny way, you would say, like, after, I don't know, 20, 25 years in this business, like, aren't you sick of it? And there's a good argument that there's many things you would get sick of. But the thing that's most interesting about it to me is just that you examine yourself, you know how often you're right and wrong, and you have a good gauge for it, and you know how bad it is when you're wrong and things like that. And so it almost has a therapeutic effect to it as to how good and bad you are, and when you've been lucky and when you've been smart and things like that. And I do like that. And I guess so the limitations, I often feel that, you know, there's a type of person who is a long-term sort of single stock type trader. And I'm often jealous of them because they get to feel really smart because they bought like whatever the hot stock of right now is when it was way, way lower, and they're a smart guy and everyone knows they're a smart guy. While I unfortunately know how much of an idiot I am because I have repeated mistakes to deal with.
You mentioned in an interview a few years ago that 90% of your time is spent on research. Is this because the effectiveness of previous strategies you employed decline over time, forcing you to have to constantly come up with new strategies?
Yeah, I mean, that also is like, whether people recognize it or not, that is just the way that markets work. You know, like you can't come up with a good idea at the age of 20 and expect to sort of feed off of it every day for the rest of your life. And I think that's almost one thing I try to push to people is, you know, because often people sort of, they will say if they decide that you know something that would be useful to them, and they sort of want to say to you, well, Patrick, tell me the thing that I need to know in order to make a lot of money in markets, because it changes. And it is required. This was one of the great lessons from working with Vic Niederhofer, because he had this idea and he actually took it from, do I have the book here? I used to have it around here. I had this book by a guy named Bacon called, it's something turf betting. I forget what it's called. It's a gambling book, though. And Victor encouraged me to read all of these gambling books because the gamblers actually know that they are exposed to chance, to fortune, and to good and bad decision making. And the nature of markets, you know, Bacon points out in the book that we'll say if someone worked out that the biggest horse always won the race or something like that. So all you had to do as a turf bettor would be to turn up at the race, bet on the biggest horse and it would win. Well, what of course happens is that over time people work that out, and it almost doesn't matter what the signal is, but people work out the signal that shows the likelihood of winning, and people start to bet on it. And the more people that bet on it, the odds change. And so even though you might be right about picking which horse wins, the problem is that because the odds have changed, your wins will be smaller, and then when you're wrong, your losses will be bigger, and you'll eventually have turned a winning thing into a losing thing.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
And markets are exactly the same as that, in that any big idea, anything that works today will be discovered. It has to be discovered. And that pace might change a little bit over time, but it throughout history, this has to be the way it works. And that once your trade becomes well known and once anyone can do it, it can't work anymore. And so you have to always find new things. And so there really is no sort of secret sauce or secret idea that to always find new things. And so there really is no sort of secret sauce or secret idea. That the real secret is just to keep grinding away, to keep working. And really, that's even why, there's a funny thing where people say to me, oh, you're a quant, you're not creative. Other people are creative, but people like you just like numbers. And it's like, well, no, because the numbers just answer the question, but your creativity comes up with the question, right? You have to think through, you have to sit there and look at markets and look at things happening and say, I feel there's a thing that's happening here. I wonder if there's an advantage. And then because you're capable with coding or numbers or whatever that's happening here, I wonder if there's an advantage. And then because you're capable with coding or numbers or whatever, you're able to test it. But all of the money comes from creativity. It comes with coming up with good ideas, or even coming up with smart ways of testing an idea that other people maybe can't come up with.
Mm-hmm. So do you find that is it easier or more difficult now to have your trade ideas last a certain period of time now versus before? So in the past, computers were more expensive. There was less competition, and now computers are much more powerful, easier to research trade ideas and what have you, but you have a lot more competition. Is it better or worse today? And how long?
It's harder in a funny way because I've got experience. I've sort of made lots of mistakes. So I think I'm quicker at knowing what's a good, what's worth pursuing and what's not worth pursuing. Like that was the problem when I was young, was that I didn't know when I was wasting my time and when I wasn't. Now I maybe, because I've tested a lot of things, I maybe have a bit of an instinct. Like a funny thing is, years ago, like in my first few years of trading and analyzing, I would find like what looked like the world's greatest trade. Like you'd be like, I found the holy grail. I remember once finding some amazing trade with like the best statistics you've ever seen. And I brought it to Victor. This would have been like a month or two into my job. And I brought it over to him and said, this is an amazing trading strategy. And he said, yeah, it's too good to be true. Check your code. There's an error in there. Mm-hmm. And I it was kind of outraged. I was like, there's not an error in my code. Like, why doesn't he believe I've got this great idea? And I went away and dug through it. And sure enough, there was a mistake where I was using I'd swapped my variable. So I was predicting the past with the present, which isn't very useful. But he had at that point 40 years of trading experience, and he just knew that there was no opportunity that good. Like if it looks too good to be true, there's a problem. And sure enough, there was. And so there is a benefit to experience. It is harder. Like there's a ton of smart people, and also even trading costs have come down and things like that. Because even one of the early advantages was just that if you're trading at a fund or at a bank or somewhere big, because you trade a lot, you get cheaper trading costs and so on. I think that's maybe become a little bit more widespread. You can still, as an institutional trader, you still get better costs than other people, but there is more competition. But there's also, in a funny way, there's more people making mistakes as well out there, because there's lots of really smart people doing really smart things in the market, and then you have a bunch of people who kind of don't know very much and have way too much confidence in the markets. And so there's maybe a mix, but I in truth, I've always, like my whole career, I've always thought that I'll turn up one day and find that it all no longer works, because that kind of is the expectation, that eventually it'll all be washed out and you'll just be, looking at entropy. But,
Yeah, the 2010 flash crash has been blamed by some traders on machine trading. How did this event happen? And has the lesson been incorporated into most models today, making such an event unlikely to occur again?
It's a bit of an interesting thing because I feel that overall, like the way they blame the flash crash, I think that they don't truly know what caused the flash crash. The flash crash was a mad sort of a thing that happened that lasted a couple of hours. And they sort of blamed a guy trading out of his bedroom in London for sort of spoofing, which I don't really believe, because I had, when was that? It was 2010, and I had probably been trading for like 9 years, like fast-paced trading at that point. I had seen people spoofing in markets for that entire period. Like I remember I used to see these massive trades come into the book in the Bund only to disappear as the market got close to them and so on. It was very obvious to me, for a very long time. And I think anyone who was a reasonably active trader saw spoofing and knew it was spoofing in the markets. I think there were a few things that caused the flash crash. There was this idea that it was caused by one guy or by a group of traders who were sort of manipulating or bullying the market around. I would argue that a big part of what happened was that market making had become much more algorithmic at that point in time. And if you're a fast-paced trader, actually a good example would be even during the market would move very rapidly and you'd get a fill and you'd then exit that trade. And only, we'll say like an hour or so later, you'd get a call from your broker that would say, we've undone that trade. That was an erroneous trade, right? So anyone intelligent at that point knew, like we'd just been through a period of great volatility and we had seen people's trades just being unpicked because they were considered unfair for a variety of reasons. So any quant trader at that point knew that once the market moved a certain amount, there's a very good chance that any buys or sells that you put in, the winning trades will be unpicked because they're deemed to have occurred in an unreasonable market. So what do? You shut off. Your system is set up that once the market has moved more than a certain amount, you just stop trading. You back out and you come back when the rule makers have decided which trades are fair and which are not. And so I think a big part of the flash crash was simply that a lot of automated market makers and a lot of fast-paced traders like me just backed right out of the market when that started happening. Because if you bought at the low on the day of the flash crash, you could have made a fortune, right? You could have been in and out and made a fortune. But there's a really good chance that they would say, well, your buy is invalid and now you're short the market and it's gone up another percent. And it's like, I'm not playing that game. And no one sensible wanted to do that. And so I think the real reason that liquidity just disappeared was that people had learned that lesson. But always, whenever there are these big events in markets, it's very easy for people to come in and say, this happened because of this. But we don't really know. Like we can say that, there's probably like 10 different things that work together to cause that sort of crazy event. Could it happen again? Definitely. Like, I mean, anything that has happened can happen again, and many things that haven't happened will happen. So,
Yeah.
actually, that I studied at London Business School with a guy called Elroy Dimson, and his great line on risk is that his definition of risk is that more things can happen than will happen. Like essentially that there's just more out there than you realize.
According to the SigTech hedge fund report, only about 22% of hedge funds use a purely quantitative strategy. Why do you think that there aren't a lot more that are using a quantitative approach if the quantitative approach can show that it has positive alpha?
For one thing, just different people are good at different things. Like quant trading appealed to me because I didn't like just buying something because I felt good about it. I wanted to have a good reason for doing it. And that just sort of appealed to my way of thinking, doesn't appeal to other people's. But also kind of back to that idea of ever-changing cycles. Whenever something works well, it draws people in, and then there's sort of too much money chasing too few trades, and so it disappears. A great example of that would be convertible bonds, right? Because back when I started working for Victor, all of the hedge fund launches in the early 2000s were convertible bond arbitrage. And this was because Ken Griffin had made a fortune in convertible bond arbitrage. And everyone decided this was, it was an easy way to raise capital if you launched a converts hedge fund. And so all of the capital came in. And the whole reason convertible bond arbitrage worked was people were mispricing convertible bonds, and there weren't enough people who knew that. So they'd buy the cheap bonds, hedge it all out, and make money. Once you can raise tens of billions, there aren't enough convertible bonds to do that with. And so the nature of markets, it requires that people be doing different things. Like if everyone is doing the same thing, that thing can't work. And you can almost look around, like even, recently, all of that sort of growth stuff worked basically from, 2009 till 2021, growth. The FANG stocks were what people had to own. It couldn't keep going like this. This small basket of American technology stocks can't lift the entire market forever. And so once everyone is doing that, something else that has to end and something else has to start. So a market would never work if there weren't a bunch of people doing a bunch of different things. And even just that idea of efficient markets hypothesis, the market can only, whenever, in fact, it's a terrible thing almost, whenever quant does awfully well, a ton of money comes in. But it doesn't just come to me, it comes to every quant fund. And then they pile it into the exact same strategies. We'll say last year they made $1 billion in a strategy. Well, now they're throwing 3 at it, as are all of their competitors. The trade isn't big enough for that. And so then you see 2 years of sort of sideways or losing trades, and everyone loses interest, and they move on to, whatever the hot new trade is. They pile into Cathy Wood's ARC or whatever, and that blows up on them. And so, you can't chase last year's or last decade's winning strategy and expect, this year to be a photocopy of last year.
So how has 2022 been for you? Have you had to switch strategies, and do you still dislike shorting? Do you still dislike shorting? Last year was actually a very good year for me. It's one of my better years. Interestingly, I do specifically dislike shorting. Like actually, almost every trader I know, there's very few people who are really good at shorting, and almost everyone else, there's so many people I've met and they kind of go, I wish I had never heard of that approach, because, shorting is always swimming against the tide. If you look at it, 8 out of 10 years are up years in the market, 8 out of 10 days are up days in the market. Like the market tends
to grind up. Like I say that, like if you can look at 100 years of data or whatever it might be, you can swim with you can swim up or down the river. It might be easier to swim down the river. So you always require, in my opinion, you need to qualify your trade better. Your analysis needs to be better to be good at shorting, because if most of the time the market goes up, you can be long stocks and wrong about your idea and possibly still make money. While when you're short, you have to be really right. You have to catch it. Many years ago, I did a lot of analysis. I moved towards certain ideas that are a bit longer term in nature. And one of them is just that if you look at the returns of markets during different Fed cycles, most of the returns in markets occur during periods of falling interest rates. In fact, if you look at things like the FTSE, if you move away from American stocks and look internationally, you'll find that almost all of the return in the stock market occurs during periods of falling interest rates. So during periods of falling interest rates, I have short trades really, really reduced to a very low level. I'm more confident shorting during a period of hiking interest rates because there's just more of a chance. It's not even that I believe that markets will fall in that period, but there's less of a chance that they will ramp in your face, that you'll get brutalized by them. But I've even found during periods, like when I look at my returns during the worst days of the credit crunch and things like that, surprisingly, I often find that most of my profits in a down market occur on the long side. I found during the credit crunch, like often I did quite well catching the bounce after the fall, much more than I did catching the fall. So last year was quite a good year. It was sort of interesting because there was a lot of irrationality leading into last year. And there's a bunch of things you can look at, but there were a lot of bubble stocks. And sort of having been through the dot-com bubble, when you saw I forget, did Tesla go up like 70% when it was announced that Hertz had bought a couple of cars from them? Like a company that was almost bankrupt was going to buy some of their cars. They were already sold out, and somehow that added, $500 billion of value to the company. AMC and the GameStop stuff. You had all of the, and many other meme stocks. And it felt very like the dot-com bubble. I think the big thing that made it feel to sort of traditional investors, it felt less like the dot-com bubble because of crypto. And because in the 1990s, the money went to publicly traded stocks. So everyone saw the NASDAQ. While now people were kind of that there was some coin with a picture of Elon Musk's dog gone up 10,000% in a day, and they thought, well, I'm not getting involved in that. So I think a lot of regular people almost didn't see what was happening, but the real fraud was in stuff that most people couldn't or didn't want to get involved in. And so in a way, this recent bubble, many regular people were kind of saved from it. They kind of got to watch from the sidelines and have a bit of a laugh. Mm-hmm. But last year was a rationalization, and there's still many of these things that are trading at price no sense. And the bubble boys are still big believers in it. But I felt last year was sort of a good year for anyone who took a long view of markets, and by that I just mean who'd been around for a while and didn't trade with sort of FOMO as their main trading signal. And also, there were even things like you come into last year, there was all this stuff about how no one was going to buy oil anymore. No one's cars were going to be, we were all going to be driving EVs in a year and there'd be no oil. And you look around, you're like, well, there sure seemed to be a for this oil that everyone says that no one wants. And no one's allowed to drill any new holes in the ground, so it's not really that surprising, we'll say. Like, you could have invested in the oil industry very cheaply during the lows of COVID. And just a simply, like, this is a totally non-quantitative thing, but just a simple look at it, like where you could kind of say, well, like, is this an industry that will be shut down, or will it trickle along for another 10 years? If it's going to still be around in 10 years, you can sure get on board cheaply now. Equally, you saw things like in January, I feel, of last year, there was, China fired that, they were testing these hypersonic weapons, and everyone was saying, well, what are these things? They're better than what America has. And it ever so slightly seems like a no-brainer to look at defense stocks and kind of say, like, so is the United States going to watch China test fire weapons that they don't have, or are they going to start developing those weapons? And if they're going to develop them, is Lockheed Martin a good buy,
Mm-hmm.
And so, and then even you look at things like the, value versus growth and things like that, like kind of, value which had underperformed, like I said, since the credit crunch, right? Like there's a lot of stuff that's, people think that we finished a big bull market, but we really didn't. If you look, most stocks never rallied really after the credit crunch. If you look at international stocks, they've been sideways for, 10, 15 years. There was this small handful of tech stocks that achieved massive valuations, that we're all just sort of selling advertising on the internet, right? Like, Facebook, Google, these advertising companies, right? How can advertising do that well if if the people who are buying advertising are not doing well? So in a funny way, apart from like quantitative strategies working reasonably well, there was also even just a lot of sort of common sense investors did reasonably well over the last year. So.
I'd like to transition to managing risk and false expectations. Isn't it common? I mean, can't we expect as a natural phenomenon that as markets rise sharply, that people buy into this idea, well, maybe this time it really is different for all these various reasons. And so, the expectations of maybe 10% a year, well, why not 15 or 20%? Because the narrative is so powerful. And so the question is that how do people get swept up in false expectations? Is it a lack of historical knowledge? Is it a lack of statistical knowledge? And how do we protect ourselves from false expectations?
So I think a big part of it is a lack of historical knowledge, but also the truth is optimistic people are drawn to markets, like kind of real pessimists would never own a stock. They buy bonds, they're careful, they buy gold, or, do sort of really safe things. So the most optimistic, the dreamers, kind of buy stocks, and so then when that goes well, those are the people who get carried away. And I think almost anyone I know who works in markets, I didn't maybe like the sort of perma bears, but most people in markets tend to be, actually, even if you're a big bear, you're still optimistic about your ability to make good decisions or to ascertain value. And so I think people in markets tend to be optimistic if they don't believe all sorts of kind of things. And I think that's sort of where a lot of kind of con men and charlatans, won't name the fund manager, returns a year over the next decade there about a year ago, and she just didn't mention that there might be a minus in front of but again, I was very lucky. I mentioned him earlier. I was very lucky to work with Elroy Dimpson at London Business School. He was my thesis advisor, and he is sort of, I would almost say, like the number one market historian, because he's a guy who put together a collection of stock market data from almost every country in the world since 1900. He has this huge trove of data, and then he does this really interesting analysis on it and sort of tries to pull truths from that data. Mm-hmm. And when you look at that data, there are certain truths as to how you can do. And even one constraining principle is that if you feel that your likely return is significantly higher than anyone has ever achieved in the past, you might be right. If you're Jim Simons, you might be right. But if you're some guy at home who's like working 9 to 5 and sort of reads a few chat rooms and buys stocks, chances are, that you're not going to outdo every investor. Kind of how markets work, like what returns are generated from markets. It's also really worthwhile studying people who've lost fortunes, and how they've lost fortunes, because we can all make those mistakes as well. And maybe, one of the great things about just reading in general is that you get to sort of experience things that you haven't really experienced. You get to sort of see other people's lives and walk in their footsteps and maybe learn things from that. In fact, it's sort of one of the things that in one of my videos I made a while ago about Sam Bankman-Fried, one of the things that really surprised me was that he was put forth as this awfully smart guy who never read books, and he thought it was an absolute waste of time ever reading anything, and sort of said the most you should read is like a tweet or a blog post. And I thought, gosh, Sam, if you had read a few books, this wouldn't have happened to you, because this is what the rise and fall of Sam Bankman-Fried. There's almost every decade. There's one person who shouldn't have been surprised. Sam,
Yeah. So then when it comes to scams, tips to help us avoid scams. I mean, some of us are smart enough to understand, well, if they offer you 2% per day in this trading technique, obviously that is unrealistic. But what about the more subtle scams? Like, my understanding is that Bernie Madoff had seemingly reasonable and somewhat, and yet he was a big scammer. Is there a way that investors can protect ourselves from these scammers?
Well, that's a bit of a pet question for me, because it's something that kind of fascinates me, because I teach financial derivatives at two universities in London. And when the Madoff meltdown occurred, I was fascinated by it. And as you say, his promised return was, I think, 12%, or the return was 12% a year over a very long period with pretty much no volatility. But there were still things I go through an example with my students to say, what could someone who understands derivatives know that would highlight that this was a scam? Well, to start with, it was, at least on a Sharpe ratio basis, like on a risk to return basis, it was very surprising. Like, it was a type of return, the likes of which was very rare. So straight away, if something's very rare, maybe it warrants a little bit more research. Now, Bernie Madoff, it would appear over time told investors that he did different things with the money. But at his peak, like when he was at his biggest, I believe he was telling people that he traded a split strike conversion, which is just a fairly simple option strategy. He only took money from sort of fund of funds kind of professional investors. And if you were a professional investor, it might, and I think he also told them that he only invested in big stocks that were in the S&P 100. So a simple, if you were given the job, like rather than sit and talk with him and be charmed with him, you might sit down and just look at the stocks in the S&P 100 and say, how many of these stocks could you trade a split strike conversion on and actually attain the kind of returns? Name right now, kind of the famous hedge fund guy / poker player. What's his name? Can't think of his name, but anyhow, he looked rather quickly at, I think Jim Simons as well looked at Madoff's returns and quickly worked out it was a fraud, because if nothing else, he wasn't doing the thing he said he was doing, because you couldn't get that return from that strategy. Because even if you picked every month the 10 best out of the 100 stocks to trade that strategy on, you wouldn't be getting a 12% return per month. So it was extremely unlikely. That's kind of one giveaway. And so as a professional investor, you need to do the work. Like, you need to build the spreadsheet. You don't just go and talk to a guy and go, wow, Bernie, that's amazing, But then even there's a few other interesting things. I know a few people who met him and they tell me that he was an awfully charming guy. Like, they say that, any doubts you had, you sat down with Bernie and you would just think, gosh, he's the best guy in the world and he's honest and decent and so on. And, and I think that's really how he did trick people. And similarly, I've studied Charles Ponzi and a lot of other con artists as well. And one of the big takeaways from almost all of them is that they're unusually charming people. So you almost don't want to talk to them. You actually want to just look at the numbers, because if you're susceptible to being charmed, these are the guys who will charm you. What else might warn you about them, though? I guess the Bernie Madoff, this was before he blew up, and it was because Bernie Madoff was actually the guy who invented payment for order flow, that's been in the news a lot over the last few years. And we did a class on ethics where we looked at, we had to just look at a case study of Bernie Madoff and whether it's ethical or not to do what it is he's doing, to pay for order flow rather than to have the trades executed on exchange. And I think that a lot of the people who invested with Bernie Madoff possibly felt that he was doing something crooked, because there was always this question mark overhanging even his market-making business. And then that he's running an unusually profitable hedge fund on the side, it's possible that some of the investors thought that Bernie was ripping off his brokerage customers and putting the profits in this strategy. You were sort of in with Bernie, and I even think, when you look at Sam Bankman-Fried, there were a lot of question marks, a lot of things in the crypto space, like no one is ever that surprised when sort of these crypto heroes fall and you learn that they were crooks, because everyone kind of goes like, yeah, they sure looked like crooks all along. And I think that many times, like, those Nigerian scams, and they sort of say, like, my father stole all this money and he buried it, and I need you to help me get it out of the country. And so they kind of get you to conspire with them and to do a criminal act in order to be profitable. And I wonder if a lot of Madoff investors thought that he was a crook, but he was their crook. And they thought Sam Bankman-Fried was a crook, but he was their crook, and so on.
Do older strategies, say first employed decades ago, quant strategies, do older strategies, say first employed decades ago, quant strategies, like say, for example, a simple mean reversion strategy, ever become effective again as other quants give up these older strategies? For newer ones?
I do study all of my trades that I used to do that I no longer do. Like I there's a point at which if they're not doing well, they get pulled from the live system, but I still analyze them. And an interesting thing, there's a few ways of looking at it, but I worked out a little bit of an idea back actually during the credit crunch, because what happened in the credit crunch was we had gone from, a very volatile market in the early 2000s to an absolutely dead market for a couple of years. As I said, sort of 4% range in the S&P, to suddenly explosive markets. And suddenly a lot of the old strategies that used to work started working again during the credit crunch. And I think that it's just my theory, because I always have like an idea behind why a trade works as well as just the numbers of it working. And I think the real reason that trades work, like that certain trading strategies work, is that they trigger our emotions. There's sort of that Mike Tyson line that everyone has a plan till they get a punch in the mouth, And suddenly during the credit crunch, people were delivered punches in the mouth and they woke up. If you were sort of dozing through the day, like eating a sandwich at lunchtime and whatever, and the market's moving 4%, when it's suddenly gapping 10%, like you're, white-knuckled glued to your keyboard, right? And you think differently and you behave differently. And when the market frightens you, it really moves the market around. And so if you can find sort of things you can measure in the market that might describe, how emotional or how calm the market is, those factors might help you find trades that will work in the current environment. If you can find similar environments and see what worked then, will that work now?
So, in closing, what are your biggest struggles in trading that you've been battling recently, and how are you overcoming it?
I think my biggest struggles are sort of the struggles that I've always had, because there's kind of a funny thing where I don't know, maybe other people are different to me, but I almost like quantitative trading because it takes the emotion out of trading. Like you don't it's you're doing the correct thing. You're sort of gambling optimally, like a card counter does or whatever. But there still is always a thing where throughout my career I found that the best trades are the ones that I least want to do. It's when you're buying and you think you would be ashamed to tell anyone this. Like you kind of think like, I'll put the trade in, the trade's going in, but if I lose money on this, I cannot tell anyone like that I was foolish enough to buy on a day like this or to sell on a day like this. And those always seem to be the trades that work. And that's even, I think, why quantitative trading appeals to me, is because it sort of forces you to do the things that you don't necessarily want to do. Because I think if you always do things to feel comfortable, you're always with the herd, and you can never really stand out. And I think that actually, even the reason, as I said earlier, the reason that markets and the trading are interesting is simply that it's a battle of managing your emotions around sometimes frightening or overly exciting things. And then you also always have to tell yourself, like, when things have gone well, you have to tell yourself, calm down. It's not, you've had a bit of luck here. The long-term expectation is what it is. And if it's gone really genius, it won't necessarily go well over the next 2 weeks. And then equally, if it's been horrible, if your system is good, if it's wise, if it's well thought out, if it's well tested and not riddled with flaws, it's reasonable to keep trying it until you can find a reason that there's something maybe deeply flawed in what you're doing. So,
well, it's great having you on the show, Patrick. Thanks for coming on Chat with Traders.
Thank you. It's been a pleasure meeting you.
Yeah, and how can listeners get in touch with you, or to learn more about you?
Well, the biggest thing I do is YouTube. I have a YouTube channel and I put up a video a week, and it's often just sort of things I find interesting in markets. That's kind of the biggest thing. I'm also on Twitter. I'm kind of reasonably active on Twitter, mostly just causing trouble, annoying people. That's kind of the big two places to find me online.
Great. Yeah, I've certainly learned a lot from you on your many YouTube videos, which are very, very interesting.
Oh, thank you.
Yeah, fantastic.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools as a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
One of the things that really haunts us, all traders, is discipline, right? It takes so long to develop that discipline to patiently wait for trades to come to us. And I think because of what I've been through, the kidney failure, if I didn't go through that, I don't think I would have had the discipline enough to be patient to wait for the
markets, speculation, and risk. This is the Chat with Traders podcast. Markets, speculation, and risk. This is the Chat with Traders podcast.
This is Chat with Traders. I'm your co-host Tessa, and we're so excited to Chat with Traders. I'm your co-host Tessa, and we're so excited to bring to you episode 254. In the last episode, I asked you, what keeps you in the game of trading? And I'm going to ask you again because I'm serious. We want to hear your voices. I especially want to hear from you. For you traders out, we want to hear your voices. I especially want to hear from you. For you traders out there, we know that trading is challenging. Trading can be lonely, but you're still in it. Why are you still in it? What is it that keeps you in the game of trading? Don't think too hard. Just go to chatwithtraders.com/speak and speak into the microphone and record what's on your mind. We want to compile our listeners' voices into a special episode. It's that simple. We'll even email you Chat with Traders' popular ebook, Traders Never Succeed, which is...
Yeah.
I'm in Los Angeles in California. I grew up and was born in Mexico, and shortly after, and this is because my sister had developed kidney failure at 3 years old.
Oh, wow.
And so that's all I knew. That's all my family knew. Unfortunately, my sister passed away. We couldn't do anything in time. She needed a kidney and a heart transplant. And ultimately, there was just no more time left. And so that sort of starts the journey that I've been on over the last 30 years now. After that happened, my mom felt betrayed. She, being how Mexico was back then, she donated a lot of money to the hospitals, to the doctors, so they could do whatever they could to save my sister's life. And she felt that they could have done more. They didn't. And so she wanted nothing to do with Mexico. That's the way she put it. She gave away her cars, the house that we had back then. We had a small ranch. She gave it away. And we came to California about when I was age 7 with pretty much no money. And that's really where my life started here. I went to school. I learned the language. And I wanted to play baseball in sophomore year. And while I was getting my labs done, the doctor comes in and tells my mom and I that I shouldn't even be walking because my kidney function was only 6%.
Oh, my God.
Yeah. So as you can imagine, from that point forward, it was just a complete repeat of what we lived through in Mexico. I had to leave school. I started dialysis. And so from age 14 to 16, that's all I knew. I did dialysis for a year. Eventually, in 2006, we found out that my mom was a match. She ended up donating a kidney to me when I was 16.
Wow, your own mother donated one of her kidneys to you?
Yes. So
did one or both of your parents stay home or had to stay home with you to help you through this process?
During this time, this was right before 2008, right? 2006 to 2008. My mom owned the hair salon. So she had the freedom to take days off from work because she wasn't tied down to an hourly pay like my father was. She was able to join me. It was like every time we went in for dialysis, it was a full day work shift. For us, it was throughout the whole year. So you can imagine that my mom's business started to slowly fail. Where it affected us much more than just having somebody who was sick and having, your parent, one of your parents being able to take time off from work. because of a financial foundation that they had set up years prior, right? We didn't have that. When we came from Mexico, we lived on food stamps here. We lived in a one-car garage for 3 years. We lived in there when we came, right? So we had no financial literacy. And it sort of trickles down, year by year due to all these choices that we made. And it really hit us the most during my period of kidney failure.
Just curious, do you know what are the attitudes towards financial literacy in Mexico? I've read some statistics that show that Mexicans on average have a much higher savings rate than Americans do. I don't know, maybe you know more about that than I do, but what is the attitude there toward financial literacy?
From my experience, I can tell you that it's more about party now, save later. It's my culture is really big on drinking and partying and celebrating just these, what I believe are random events. And due to this, you sort of enter a cycle where, at least from my experience, right? Now maybe different for wealthier families, but in my experience, putting money away for retirement. We certainly didn't do that here. In Mexico, we did a little bit of that because obviously my parents had a better understanding of the economies back then. And so that's my experience. Here, it really wasn't that. We didn't really have any big financial goals. It was just put money under the mattress and save it until you retire. And then that's what you live off of.
Okay. So I gather that investing or trading is not very common in Mexican culture.
Yeah, no, not maybe recently, but back then it wasn't. It was, like I shared, just celebrating life.
So your mom certainly had to sacrifice quite a bit, letting her business situation deteriorate to take care of you. Did your dad make enough money to support the family on his own, or did you guys need both incomes?
We did need both incomes. You see, the issue with what we experienced was that I like to say that even though it was not a good time back then, but it was probably the worst case scenario that somebody could go through. All of our savings went towards trying to save my life, age 14 to 16. That thankfully that happens. We get a kidney transplant, and just when we think everything is the worst is behind us, 2008 comes, and because my mom no longer had a solid business, to rely on, we tried to rely on my dad's income. However, 2000 hit, and being that we were in or at least they were in low income jobs, my dad ended up losing his job in 2008. And so this resulted us getting into a very depressive cycle of my dad developing a drinking addiction, my mom developing a gout. I started hanging out with the wrong crowd. And this all came due to us not having sort of foundation around our finances, right? Just imagine what our life would have been if we had even $50,000 in a retirement account that my parents were investing for the future. That could have saved us tremendously, but we didn't have that. Any kind of savings that we had went towards saving my life because we didn't know about whether it was health savings, life insurance, right? There's life insurance policies that if you go through a chronic illness, they'll give you that death benefit up front. How could that have changed my family's life if we had that back then, right? Those are the questions I think about now.
Right. How did you respond or kind of react to, your mother getting into gambling and your dad getting into drinking? How did that affect you, and what did you do?
It was a very negative impact. It really affected me because as I was just going through this experience of, hey, you didn't die, right? Your sister passed away. I was lucky enough to get a transplant, but the love at that moment in time, right? The love was not there in the family. We were all dealing with our own separate mental, spiritual, financial issues, rightfully so. And because of that, because that love wasn't there that I was looking for, I started hanging out in the streets with the wrong crowd. And I ended up in jail on my 3 days after my 18th birthday.
Oh, wow.
And
Wow.
so now I didn't spend much time in there, but the time that I did spend in there, I realized that I shouldn't have been there. I realized that I did have a second opportunity in life. And I realized that I was wasting that opportunity because I was hanging out with the crowd that I would see friends either get shot, killed, or end up in jail. And I was in jail. So I realized that I needed to change my life around. I realized that I needed to do different things so I can help my family out and get out of the situation that we were in.
I see. So when you got out of jail, what were you motivated to do then?
First was get to school. I went to college. I was not planning to go to college prior to that. I entered college, and in an investing class that I was taking, I learned about the stock market. I learned that you could make money buying and selling stocks. I learned about residual income. And so I said, hey, I need to learn about residual income, because if in 20, 30 years from now, my kidney function goes down again, whether it's my health or my family's health, something happens, what can I do to create income when I'm no longer able to work? And I realized this because throughout age 14 through pretty much 20, I realized that I was unemployable. I was in dialysis appointments, I was in doctor appointments, or I was simply just not feeling well. While my mom, as a business owner, right, this was my perspective back then, as a business owner, because she was catering to a child of hers that had an illness, she was not unemployed. She was unemployable as well. And even though she owned her business, and the perspective of owning a business was this grand accomplishment, it failed for her. And I realized, well, obviously you can't be an employee with an illness like mine, and you can't own a business. So what do you need to do? You need to find a way to create passive income.
Mm-hmm.
And that's when I learned what trading was, and I learned, hey, maybe this can provide passive income for me. But obviously we all know that it's certainly anything but that.
Right. So these classes that you took were catalyst to get you into the investment world, right?
Yes.
And how old were you when you opened up your first trading account?
20 years old.
20 years old. Okay. So it sounds like you had a couple years after these classes to earn some income, save it up, and to fund your first account.
Yeah, I worked at a bar. I was thankful enough to make a good living back then through tips, and all my tips just went into the. So my first trade ever was an option trade on. I didn't idea what I was doing, but I bought some calls. I doubled that account, which was just $1,500 a week later, and I realized, wow, I'm going to be rich. So I ended up losing $15,000 throughout the year after that.
Oh, wow.
And I thought I would reach some sort of big accomplishment and reach success much sooner than obviously what it took.
Mm-hmm. Did you have any strategies that you adopted early on, or what was your methodology, if you had any?
So for the first 3 years, I made no money. I wouldn't say I had a strategy, because there was just I got lucky on some trades, I guess, and I would make money. But it was just, hey, I read this book. It talks about this approach. Let me try it for a month, 2 months. Hey, I saw this video on YouTube, talk about this approach. Let me try it for 2-3 months. That's pretty much what it was those first 3 years.
Hmm. How much of your losses were due to lack of risk management?
Gosh, I would say almost all of them. Now what I know about risk management, I wouldn't say I knew it back then. I did not look to enter a trade with a, let's say, 3-to-1 risk to reward ratio. It was, I think the price can get to this level, so I'm going to buy it here. And if it didn't go that way, then I'd get out of the trade probably at some point where the emotional impact of the loss was just high, right? It was really high at that point, and that's where I'd say I can't be in this trade anymore.
So how did you turn it around?
Trial and error. On the 5th year is when I finally made some real money, and this was through what we can get to in a bit, but it was just from trading from one area of support and resistance to another, and it's just trial and error and doing multiple trades that I sort of started to put the pieces together and understand, hey, if this happens, then most likely this happens over time. And eventually I did well the fifth year.
I understand partway through your learning process, there was a particular year that you adopted a burn the boat strategy, no food until becoming profitable. Could you share with us a little bit about that?
Yeah. So like I said, I worked at a restaurant, bar, same thing. I was so hungry for success. I wanted to make it so bad that I felt like the only way I would make it was that if I stopped working and relied on profits from trading as my income. And so I took an absence of leave from that job and I started trading. And I feel like that is really what turned things around, because ultimately it is through that sacrifice that really forced me to look for A+ setups only, right? And create the discipline needed to have the patience to only wait for those opportunities. Instead of thinking, hey, this looks good, I'm going to trade it. I really said, if I want to eat, I need to make sure that I'm allocating.
More info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital, or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like. So you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
How did your family respond to your you getting into trading? Were you able to share with them the kind of the ups and downs that you went through?
I couldn't. That's a good question. I couldn't. And I can imagine that's the same case for many traders out there starting. It's being that, well, especially for us, right? That financial security was a really big thing after what we went through. My parents didn't understand how I could be risking money like that and losing it. And even though it hurt, even though it was painful, what was more painful for me was going back to that time where we didn't have our finances set up, that when an illness came, it tore us apart. So I simply saw it as, this hurts now, but if I continue at it, I'll get to a point where I find success. And if somebody, passes away unexpectedly, that was simply my goal. And that's really
with your parents, your goals, or were you?
I shared, but they didn't believe them. They didn't know much about the stock market. They didn't know how it worked. They thought I was just losing money and gambling. and I couldn't share much above that. It was, you're gambling, we don't want to know about it, you're losing money. And so that's what it was.
So kind of diving in a little bit more into the strategies you used. How many different strategies did you go through how many different strategies did you go through before becoming profitable?
I would say at least 10. It was, I mean, I tried everything. I tried, a breakout strategy or a pullback strategy, a Bollinger Band strategy, Fibonacci strategy, like just everything that I could. I signed up to all these groups back then, just learning whatever I could, and none of those stuck until I created my own.
Are there any common issues with those strategies that you implemented? But are there any common issues with those strategies that you implemented before that made it difficult? Or did each have its own unique issues that you were not able to fully mitigate?
So, I'm a big believer in learning and applying a strategy that aligns with your beliefs and personality. And I think majority of the strategies that I tried back then did not fit my personality and me. I didn't apply myself continuously in learning the strategy and applying the different parameters of the strategies across time, right? We say that you need to identify if a strategy works for you by back testing it or live testing it over 100 to 500 times. I didn't do that work. And because I didn't do that work, that was also part of why they didn't work for me.
So describe your current strategy involving boxes.
So the box strategy is simply a rules-based trend following approach that uses the trend sequence of the market in addition to zones. Now, the market moves in 3 different directions: up in an uptrend, which is just sideways. There's no denying that. And what zones are support and resistance levels. And so what I look to do is I look to participate in the trend that begins or that starts once price moves away from the consolidation or the no trend period. And I use zones to help me identify where that consolidation period takes place and where to look for profits, targets, or even the stop loss. For example, for zones, if we were to look at an empty chart of the E-mini and we were to draw a zone where this is just a rectangular zone, not a line, in between 3,900 and 3,920.
Okay, so what time period are we talking about when you say 3,900 to 3,920? Are you looking at a particular spot on the chart or just in general, just as an example?
Yeah, spot in the chart over the last 8-10 months.
Okay, last 8 to 10 months. Okay, great.
So if we draw that, right, I like to look at support and resistance lines. The zone's going to be 49 to 51, let's say, for example. So in the E-mini here, if we draw a zone from May of 2022 to today, from 3,900 to 3,920, we can clearly see that whenever price gets above it, it goes up. And whenever price gets below it, we go down. This serves as a risk on or off filter, right? Which tells me that if the market gets above 3,900, I want to participate in uptrends. If the market gets below 3,900, I want to participate in downtrends or just stay in cash. And so as you plot these different zones, which mean the same thing, right? Price gets above it, we go up. Price gets below it, we go up. You come to identify that area of consolidation. So now if you draw a zone at 4,100 in the same time frame, you can sort of see that we've been in a sideways price action for the last 8 to 9 months. And
Right.
so what the box strategy aims to do, it looks to enter at the break of that consolidation period, and it looks to participate in the trend and exit at the next zone above it.
I see. So are these zones, are they, another way to look at it, are they an area of rectangular like compression where there's a narrow range of trading?
Yes. So that area of compression is pretty much what I see it as: price gathering energy to expand in a directional move, right? It's in a period of balance, and the directional trend that comes out of that will be a period of imbalance. And I, as the trend follower, want to participate in that in order to extract money from the markets. And so, if we were to now, before I go into the box parameters for zones, there's different kinds of zones. There's weekly zones. These are zones that are of importance on the weekly time frame. There's daily zones of importance on the daily time frame, right? You get the idea. Hourly zones, 5-minute zones. So in order for us to get from 4,100 to the next weekly zone that I have here at 4,300, right? That's that we can draw a zone again at 4,300. In order to get from 41 to 4,300, we need to get above some lower time frame zones. In this example, one of those zones is 4180, which is, for the traders out there, where we've had rejection over the last couple of days. The idea here between zones is that when one zone breaks, price action is going to move towards the next zone. So in reality, if we want to move, if the E-mini, the market, wants to move from 3,900 or 4,100 in this example to going to get to 4,300. So with that idea, we can apply it as an understanding of where our stops should be, at least for this kind of strategy. Go ahead.
Can you give us an example of where a period of consolidation is? For example, I'm looking here on the 1-year S&P 500, and I see, say, for example, from December 16th to about January 4th or 5th, I see this real flat type of trading. It looks like it's going sideways. Is that an example of a kind of a neutral zone where you're waiting for it to break above or below, and you're probably not making too many trades during this time?
Yeah, so actually, that's a good perspective of the zone that you've identified, or the consolidation. The actual consolidation that applies for the box strategy is between 37.70 and 40.80. That, based on my requirements, right, that I have for boxes, that is the box of this whole period. So yes, if one is a swing trader, you're making less trades inside the box. If you're day trading, you're obviously making some trades inside the box. But the idea here is that since we've just broken out of this box, you should be long, and I am long. And I'm looking for higher prices.
I see. How do you determine the overhead areas of resistance and support? Like, how far back do you go? And when you look back at previous history, is there more weight that you put on support or resistance levels, say, done in the last year versus, say, 5 years ago or even 10 years ago? Does the length of time have any impact?
It does, because in order for it to be a viable opportunity in this moment in time, it needs to meet the requirements that are established. And one of those requirements is that price has to meet the requirements of the box consolidation in a specific time frame. So I don't know if you want to go into that specific, but on the, where is it? Here, let's do this. I'm going to delete my drawings, and I'm going to guide you to a specific area of this consolidation, which is November 8th to December 22nd. And that is a 40.70 to 39.20 range.
Mm-hmm.
You see that month-long consolidation?
Yes.
Okay, so that to me is an A+ setup. And the requirements for that is a period of time where there's a sideways consolidation taking place. You have the 9 pretty much flat. It's going sideways. You have a month-long consolidation, which is one of the requirements for time, right? It's sort of saying if there is a month-long consolidation, that to me is what I call a 50 MA box, which is a box that's surrounded by the 50-day moving average. And what it looks to do is it looks to participate in the break away from that consolidation as the 50-day comes into price to push price up. In this example, there was a false breakout and then a reverse and went down. And it broke below it around 39.20.
Are you talking about on December 13th and then December 14th, 15th?
Yes.
Okay.
So you're essentially getting long on a break, which obviously it failed, right? That was a failed breakout, but it did confirm the break on the lower end. And the idea is here that you get short on a break of 39.20 and you look for lower zones to exit. The consolidation has to be around the 50-day moving average, because what the 50-day moving average does is it gives birth to a new trend out of that consolidation. It's the main driver behind a 2 to 3 week directional move.
Mm-hmm. Do you ever use any existing compression related technical indicators like, say, Keltner channels or the TTM squeeze? Or
I use the TTM squeeze. It pretty much identifies the same thing. When you have these contractions take place, the TTM squeeze changes colors, right? It goes from green to black to red being the most aggressive contraction. And so what red signifies is that it has been consolidating in this range for a period of time, typically 3 to 4 weeks. That also lines up with the time requirement that I have for boxes. And so when you have a combination of, you have 30 days of squeeze in price, you have a red squeeze indicator, and it sort of lines up for you to say, hey, there's going to be a big energy release soon. Some are going to say, well, which direction is it going to be? And that's where the 50 MA comes in play. Most of the time, even though this example shows a false breakout, most of the time, majority of the time, price will move in the direction of the 50-day moving average. So if the 50-day moving average is moving up under that consolidation, like it is in this example, price will most likely move up out of it and continue higher into its next areas of resistance.
Mm-hmm. So do you find that the longer period of time that stocks trade in this kind of compression band inside this kind of long rectangular box, that the longer it trades within that time frame, the bigger the explosion up or down?
Yes, there's a saying, the longer the base, the higher in space. And it's very true.
Mm-hmm.
It's that we've been essentially in a sideways movement for the last 9 to 10 months, and that will usually signify a substantial move higher or lower. So far, the market has moved higher since the beginning of the year, and to me, regardless of what we see in the economy or earnings, I have to respect the technical trend that is in play here, and not only get long, but stay long until my stop gets hit.
I see. How long have you been using this strategy?
For the last 6 years. I can actually tell you the story behind this for the client/mentor that has allowed me to really grow his account through this.
Okay. Yeah.
So I got into the industry after college. I wanted to help people with their finances because I realized that, many don't have a sense of financial literacy. And so during my time in the industry, I moved from office to office, eventually started my own with a friend from college. And in that time, I met an investor who took some trust in us and allocated some of his investments towards us. In 2018, I convinced him to open up a separate account to let me manage that money with this strategy. And in 2018, we did 18%. And it worked. Not only that, but it was under the condition of no income, because it was taking an opportunity on me. Of course, I wanted to prove not only to him, but me out. And in 2019, in November of 2019, we officially started with $3 million. And by the end of 2020, we were up 64%, all trading the box strategy. And this was swing trading boxes, typically in the technology sector. And ever since then, I've been growing the account. It's currently, after taxes, a little under 7 million. And it continues to this day, just waiting for these box opportunities to appear, and enters them. And either they result in a great trade, or we get stopped out. And it's pretty much that. So now he has become my mentor in life, a successful person. And thanks to his trust, I was able to prove that the strategy did work, and that pretty much opened up the doors for me in the goals that I went out to accomplish when I was 20 years old, and looking to make a better life for myself and my family. And it's through that I was able to change my life around and get to where I am today.
Wow, that's quite a turnaround from your early years. Did your mother and father change their views, or did they, about stock trading, and were you able to share that with them?
They certainly did.
Oh, great. That's a great way to turn around. On Twitter, you wrote that fear around position sizing stems from a lack of understanding of every single variation of price action in and around your entry and stop. Could you go more into this?
Yes. So I am big on back testing. I believe through back testing, one can enter a feedback loop or a feedback mechanism that allows them to understand the different variations that price has in the price action that goes around the strategy, right? So, for example, I am a breakout trader. So over time, over the thousands of trades I've taken, or the thousands of trades I've back tested, price ultimately moves in three different directions. It either breaks out of the box and shoots straight up because maybe of some news, it gaps up, something happens, and it just shoots 20, 30% up higher right away. The next path it takes is either a normal uptrend, which is a choppy uptrend that moves from the left to the right. And then the last path it takes is sort of a initial move higher, maybe sideways consolidation, retracement to test the box, and then it continues much higher. Now, I've come to realize that is the only in and around your stop. You eventually come to realize that there's a specific trend sequence that the equity or the market creates. And it is through that collection that you can get to a place where you see this pattern so many times that you get to a point where you can go all in. And I know many are saying you should never go all in, and I am totally for that. Majority of the traders out there should never go all in. But for those superior traders who have reached a level of understanding and a level in their trading awareness that allows them to see price action in a more, I don't want to say a spiritual way, but it sort of is that, right? I have now gotten to a point where I have gone all in on many box trades. And that is something that's not suggested at all in any of the books you read, in any of the videos that you see on YouTube. But yet, I have found success in it. Now, I'm not saying I don't lose money, because I do. I may lose on a certain day, or even a whole week, I may not make money. But I will make money on a monthly and yearly basis, because my strategy is a systematic approach that repeats through time, because the trends of the underlying market repeat in the same sequence through times. It's nothing more than a series of higher highs, higher lows. That's what it's been since the beginning of the rice markets, and that's what it'll continue to be in the future. Regardless of algorithms, it's going to move in a certain sequence. All the testing, I've done all the studies across different markets. It moves exactly not in the same time, maybe not in the same length of time, right? They may not move the same, but they ultimately do. A trend is a series of higher low, and you can't deny that. Same goes for the downtrend. So the sequence of a trend, that is exactly what I'm looking to participate in an out-of-a-box break. And like I said, you see that so many times that you come to understand what requirements need to be met in order for that trade opportunity to not only be a viable trade opportunity, but to be an opportunity for you to go all in and have a life-changing opportunity.
I see. So when are you then looking at the action of the trading inside this rectangular box where it's kind of flatlining, it's not really doing that much, and that when it finally does break out of the box, either up or down, that you've seen enough of this type of price action in, and you feel very confident then to go all in, so to speak, on these when it's very super early in the process of the breakout?
Yes. There are certain conditions that need to be met, obviously, but if they do, you can certainly go all in, right? It's I think what helps me is that the move wants trading awareness that I think everybody should be looking into.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the
on the trends, on the market structure, which is a specific structure, higher highs, higher lows. You can, in fact, trade the same strategy on a 5-minute time frame. The move will be similar, not the same, because there's obviously more volatility on the 5-minute, but it is similar. And on that, it was a 200% return through day trading for 2022.
Wow, that's exceptional. Was that your best year ever?
Yeah, hopefully this year is much better.
Wow. From your Twitter feed, you stated that your goal for 2023 is 30% per month?
Yes.
Wow, that's quite a goal. So when many consider, some of the top systematic funds, maybe they make 60% or 70% per year, and that's considered very exceptional. Many would ask, how are you able to achieve such exceptional returns trading the most followed index, the S&P 500?
I think it comes down to your position size. Due to the position size that's being applied in day trading, the ES, the E-mini, the risk per trade is close to 4%, which is actually a lot if you think about it. It's really suggested that your risk per trade should not be anything more than 1%, maybe 1.5% of your equity. And this is almost 4 times that. And because your risk is that much higher, obviously, if the strategy is profitable, the return will be much higher. And that's simply it. It's just position sizing, and there's nothing fancy about it. There's no algorithms or complex approach or many indicators to look at. It's just, can you do one thing really well, and that's participate in the trend? And can you size it up to a level where your emotional and mental side is okay with that, right? Like, does it meet your personality? Does it fit your beliefs? And if so, then you can certainly trade that. It's where the trouble is in trading that strategy with that kind of position size in drawdowns, because many, and last year we were in a 15% drawdown, which can be a lot for many people. But if you have a solid understanding of the strategy, then I really believe that one will do well.
I see. Last summer, you were showing charts on Twitter of previous bear markets and pointed out the similarities with where we were in the past with what the chart looks like when the bottom is actually, when the real bottom comes in. And you seem to be making the argument that at that time, back in June, that the bottom was likely not yet in the all-time bottom. What does a bottom actually look like, and have we hit it yet?
Great question, and I didn't realize how deep you guys went back then. A bottom to me is a weekly reversal box, and what I mean by that is a 6 to 10 month accumulation period with certain requirements being met. Now, one can make the argument that what we just experienced over the last 8 months was that. Because it did meet the requirements. We have created a weekly reversal box. And so would I say if that's the bottom? I am not sure. All I can do is consider the time frame that it's on and the potential significance that it can have in future prices. And because it's on a weekly time frame, it's an 8th month consolidation period, which is pretty long. That to me seems like there will be a imbalance period that can take the E-mini to 4,500. Will we get there? I don't know, but my job is to participate in the trend and stay long until my stops get hit. And I've been long since 3,900. There's really no reason for me to consider shorts. If it is the bottom, we'll know in 6 months from now. And if it is, then I did great. If it's not, I at least participated in the trend out of it. And I did what I had to do. That's how I see it.
I see. So yeah, you're not, it sounds like you're not so concerned of like, oh, is this the ultimate bottom? Is this the time to go all in long? You're more focusing in on, changes and trends, in direction, and you are happy to play those in direction, and you are happy to play those changes and not get too tied up on if this is the real bottom or not, because you'll take shorter term trades of a few weeks to a few months. Is that accurate?
Yes.
I see. You also mentioned on your site several times about financial advisors and how they get their clients into investments, about financial advisors and how they get their clients into investments in a buy and hold strategy, and they just ride it all the way down as the market goes down. Any idea why financial advisors don't use any kind of trend following strategy or anything to kind of keep their clients out during the worst aspects of the bear market? Do you think they're afraid of the mantra that has often been put out by these financial gurus over the decades of, for example, time in the market is more important than timing the market?
Yes, that is probably the biggest reason. I would say two more are because they do not want to have those conversations, whether it's a quarterly review or yearly review, where they say, we were not invested in the market because we thought this or we thought that, the data shows this or the data shows that. We've come to understand that most of the time what's happening out there is not a real-time reflection of what's happening in the market. And so if you have a financial advisor who moved you to cash, and they're hearing all this data, all these conversations in the industry saying how the economy is going to shut down, just like in 2020, right? That was probably other than 2008, one of the worst years where a lot of people moved to cash, and they did not get back into cash until probably mid 2021. And they missed out on a year of incredible returns. I have known people who have been in cash for 3, 4, 5 years because of what they hear about the markets, because of what their advisors tell them. And unfortunately, it's as an advisor who collects fees on what's invested, one, you do not want to move to cash, and two, you don't want to tell your client that you weren't invested because of this or this or this, but clearly the market had gone up, right? So you're at risk of losing or ruining your reputation. And then three, which is a more technical reason, they ultimately don't understand how the trend of the market really moves. So, when do you enter it back in? Well, they don't know that. They don't spend the time to study that. They just spend their times in sales and in acquiring assets instead of managing risk at the portfolio level, and how that directly impacts their client, the investor.
Great, G. And was curious about, what do you struggle with the most?
Sizing up is probably my biggest challenge. I want to get into the 8-figure trade opportunity, and I think I'm facing a real roadblock right there. And I want to say it goes back to my belief around money when I was young. It's certainly, maybe subconsciously, right? I need to do the work. Subconsciously, I know how I don't know what that kind of risk means, and maybe I'm scared to take that additional risk. So that's something I need to work on.
I see. So even though you're eager to go all in, you find yourself kind of blocked or confident to do so. Is that accurate?
Oh no, I have no problem going all in.
Oh, okay.
I can go all in, and I know that if it doesn't work, I have time to make that back up because of the repetitiveness of the strategy.
Mm-hmm.
The issue for me is that I have trouble making an 8-figure trade. So currently it's a $7 million account. If I go on margin and make an 8-figure trade, I can't see that yet clearly. And one, I think that maybe is too much of a risk for me. And maybe I'm just too eager to get to that point without really taking the time to patiently getting to that 8-figure range, one trade at a time.
Oh, I see. So to get to that 8-figure trade, at this time, you would have to use some leverage.
Yes.
I see. Right. How have your parents been impacted by your great success?
They think it's great, but they also think because it's large numbers, they think I go through a lot of stress, because to them it's stressful to think about that kind of risk at that level. Even though being in the industry that I was in, I didn't really see that 7 or 8 figures is a lot of money, right? Now that I've been exposed to all the wealth that investors have, it's certainly not that much money relative to what's out there. But of course, being of how my parents grew up and how I grew up, to say that, hey, you're making a trade with $3 or $4 or $5 million, they don't know what to think of it. They think that I should be stressed out. They think that if the trade goes wrong, that I'm going to lose my job and I'm going to just lose everything. And that's where their head is at the moment.
Uh, maybe you can teach them a little bit about what you do, and they can see that they don't have to worry quite so much.
Yeah, but it's still a big improvement. It's if it wasn't for this, they probably would have never opened up an investing account or a retirement account. They probably wouldn't have become better at managing their own finances. So I still think it's a more of a positive impact than negative. That's for sure.
Mm-hmm. Oh, that's good. So my understanding is that you are waiting for a kidney donor.
I'm currently once again, going through what I went through in my childhood and my teenage years. I am in what's called end-stage renal failure. I'm in stage 5 kidney failure. My kidney functions 18%. At 15%, it's suggested for you to go on dialysis. And so thankfully, this time around again, my dad is actually a great match. And we actually just found out this week that he is a match. We just finished our test over the last 2 months. I have one more test on Monday coming up. And hopefully, if everything goes well, we may be looking at a transplant maybe in the next 30 to 45 days.
Oh, wow. That's interesting. So initially, it was your mother that was a match when you were a teenager, and now your father's a match.
Yeah. So I'm just really grateful that I'm a match for both of them. It's surprisingly, and everything's going well so far. And even though I'm going through what I'm going through, this is the 3rd time now that I'm going through this. But look, I would say that I reached my goal, which was not only make money, but secure the future if my illness did come back again. And I'm currently facing it right now. And I don't have to worry about money because the goal I set out to accomplish, worry about something similar to 2008 or something similar to what happened to my sister. And that's thankfully to the, really successful in this. One of the things that really haunts us, all traders, is discipline, right? It takes so long to develop that discipline to patiently wait for trades to come to us. And I think because of what I've been through, my biggest driver in that aspect has been the kidney failure. If I didn't go through that, I don't think I would have had the discipline enough to be patient to wait for the trades, right? I have no problem now just waiting. And if there's no trade, there's no trade. And I think that's really a big issue in the trading community. And I would say, I urge everybody to really understand as to why they're doing it. Identify what their why is, and just set that reminder each day before making a trade. Why are you doing this? Why are you doing this? Why are you doing this? And most of the time, it's for your family. You want to create a better life for your family and yourself. And that, to me, was the biggest factor in helping me overcome some mental barriers.
Wow, what a great motivator for you. And that's fantastic what you've been able to accomplish. I'd like to share a couple quotes that I saw on Twitter that you created, which I was quite moved by.
Sure.
One of them is, entitlement is birthed in the absence of gratitude. And another one was, success is finding gratitude in everything you do. I've found those quite moving.
Thank you. I am big on gratitude. I remind myself, I'm currently going through a lot of symptoms. I have trouble sleeping. I have an incredibly high blood pressure that I take just an insanely amount of medicine to control it. And over time, I realized that I still get to wake up and do this for a living. even though with the difficulties that I'm going through, this makes me the happiest. This pushes me to succeed in my health just as much as succeeding in my health pushes me to get better at this. And I can't find any other emotion other than joy and happiness at the gratitude I have for being able to do this. Not many can do this. I can still walk. I can still type. I can still press the mouse button to buy and sell. And ultimately, that comes back to me doing what I've been wanting to do since age 20, and I get to do it every day. And if I'm able to do that, what is there to complain about?
Great point. Very good point there. In closing, if you could share with us your favorite quote.
My favorite quote, gosh.
If you remember what it starts with, understand life.
Oh, what I wrote on Twitter. Yeah. Gosh, how I don't want to let me pull it up because I don't want to misquote my quote. Give me a second here. Okay, so it is understand life and you will understand the markets. Understand the markets and you will understand trends. Understand trends and you will understand yourself. Understand yourself and you will come to know consistency. And then I would say, understand consistency and you will create the life you want.
Fantastic. Thank you for coming on the show, Christian.
Thank you so much. Thank you for having me. It's been an honor.
Great. How do listeners get in touch with you?
They can find me on Twitter. My Twitter handle is trading_boxes.
Fantastic. Great. Thank you.
Once again, you guys have a good day.
You too.
This is a quick addendum for clarification on how Christian would mitigate risk on the all-in trades. Christian's all-in trades set out to risk about 5% of his account value to capture a 10 to 25% return. Since the box strategy has a defined stop loss that is replicable across all trades, what he would do is increase the size of the trade as long as the opportunity meets all of his requirements.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast on iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, limited risk traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your. It's time to trade with more capital, making it an effort. Ready to trade the pool? Click the link and join the stock trading revolution today.
Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
I got to be within the circles of people who have wealth. Their mentality is completely different, the way they view life, than the person who comes in and, they're paycheck to paycheck. Because when you live that life of paycheck to paycheck and put away a little bit money for a vacation, let's say, your mentality is, if something good happens, the other shoe's going to drop. So you have to take advantage of it. And if something bad happens, then, well, you're due. It'll turn around eventually. So you take that mentality into trading. And what happens?
Markets, speculation, and risk. This is the Chat with Traders podcast.
Hi, I'm Tessa, co-host on Chat with Traders, and you're listening to episode 255. I have a strong feeling that you're really going to enjoy this episode. Today, Ian interviews Vincent Brucisi. Some of you may know Vincent as Harry Seldon of Real Day Trading, a unique community of dedicated day traders on Reddit. As a former gambler, professor of statistics, and a talented poker player, and having had a successful career as an expert in the movie industry in Hollywood, Vincent took his poker skills and expertise on statistical predictive modeling of human behavior and ventured into trading with a goal of finding an edge. But after blowing up his accounts multiple times, he had to go back to the drawing board and hone his trading skills, mindset, and discipline to become a high probability trader before putting in another dime into the markets. Vincent is also an advocate for the small traders and shares a more holistic and contextual approach to the market. Mr. Vincent Brucisi from Los Angeles, California.
Great. Thank you, Vincent, for coming on.
Happy to be here.
Love to get a little background about you.
Introduce me based on my lineage, and I basically turned around and walked out. I'm not going to compete with E = MC squared. Not really ever going to beat that. But growing up, I was also pretty poor.
Kids are managing money?
Not really. You know what? Not really, because I wound up hating money in a way. And I gambled. I gambled away all my student loan money. I would get it and go down to Atlantic City. So I was terrible with money. And personally, I don't look at my finances. I refuse to look at my own. I don't know how much money I have, and I really don't. My wife could be taking money out every damn week, and I would have no idea. I haven't seen my bank account in years. I refuse to look at it. So I have a very odd relationship with money, but I certainly know what it's like to not know where your next meal is coming from, or to, wear hand-me-down clothes and all of that. Growing up poor certainly left a imprint on me.
You also go by the name of Harry Seldon. How did you pick that name?
So, Isaac Asimov's Foundation series, when I was a kid, I had read that series, and it's a science called psychohistory. It's to predict human behavior, and I became and even though I was being pushed into physics, I wound up actually doing my graduate work on statistical modeling of human behavior and predictive modeling. So I became a professor of sociology and of statistics, and that was my specialty based on my early childhood obsession with this idea that you could predict human behavior. And oddly enough, I parlayed that into the movie industry by writing models that wound up predicting opening weekend box office.
Oh, wow. So how old were you when you first got into gambling?
Oh, I had my Jewish side of the family and the Italian side of the family in Brooklyn. And the only thing they shared in common, I guess, was trying to shove food down everyone's throat. But the method of communication in my Italian American family in Brooklyn was gambling. After dinner, the cards came out and everyone played. So by age 7, I was playing 8, 7, 8. I was playing poker.
Oh, wow. So were you aware of the house odds and statistics?
Yes.
Early on.
Oh yeah. Every gambler out there doesn't gamble. I mean, the true degenerates out there who know who you are. They can hear me, and they want to hit rock bottom. Gamblers, true gamblers, want rock bottom. I knew going into that casino that they have a house edge. I knew that, every time I placed a bet, there was that 50.5, 51.5 odds against me. And yeah, sometimes I thought, I'm going to play the don't pass line. So fucking what? I'm still going to lose, right? And I knew, just like every gambler knows, even the ones, I have a system, you have a system of going broke. And I'd be there at 2 a.m. with my damn on that.
Winnings, you would be broke by the time you got to the elevator because you left a trail of chips on different tables.
Yes.
Yeah. What is that? I mean, describe that.
Well, because I'm pretty good at playing poker. And I would go to the poker room and play at Bellagio or wherever, and I'd win. I'd win money on the poker tables, and then I'd get up and walk back, and of course, there's the blackjack table, and there's the craps table, and by the time I got to the elevator, all the winnings would be gone. Thank God it got to the point when I finally, my wife basically would take the money from me after I won in poker, so I wouldn't have it leaving the poker room, because she knows it would be gone. But yeah, if I'm left unsupervised, not a good idea at all.
So you were seduced by these other games to gamble there instead of sticking with poker, which is what you were very good at.
Yes. Yeah. I mean, it was the thrill of it, right? It was a kind of, the idea of money won is twice as sweet as money earned, and playing poker felt like money earned. That's work. But hitting it on blackjack, yeah, that feels great. So yeah, I mean, look, I don't gamble now, but back then, yeah, I was a degenerate.
Describe for us, what is the gambler's mentality?
The gambler's mentality is very much this idea that somehow you're due, that somehow this play, this time, you're going to hit it. And deep down, you're not, right? But that you're owed. The universe owes you. But at the end of the day, what the gambler is really just trying to do, they're trying to get one over on the house. And the house, in this case, is the casino, but the house could be anything else in life, because usually the gambler, life has beaten them down. And usually the gambler, life has beaten them down. And instead of taking that responsibility onto themselves and saying, I fucked up, no, it was life. It was, I had a shitty boss. I had a shitty teacher. I had bad parents. I had this. Life has screwed me over. But with a little luck, I can get back on top. I can do it. I can be, zero to hero type story here. And it just is this constant downward spiral, because they never want to deal with their own issues that it caused them to get to the points that they're at.
I see.
Sign the checks. The people who have, enormous, the type of wealth where they could buy and sell you. And their mentality is completely different, the way they view life, than the person who comes in and, they're paycheck to paycheck. Because when you live that life of paycheck to paycheck and put away a little bit money for a vacation, let's say, your mentality is that if something good happens, the other shoe's going to drop. So you have to take advantage of it. And if something bad happens, then, well, you're due. It'll turn around eventually. So you take that mentality into trading. And what happens? When you're losing, you sit there and you hope it turns around. So you hold on to your loser. But when you're winning and your position's in a profit, what do? You want to take profit quickly. Oh no, I never got broke taking a profit. Yeah, you fucking did, because they take profit so fast, because the moment they got that profit, well, the market's going to take it away from them, and they close the position. But when they're down, well, then they leave that position on because it's got to turn around. So they take that mentality into trading, whereas a person with wealth, when they're trading and their position's up, they want to press it, add to it, keep it going, cut the loser. I don't want those losers, but keep the winners. Completely opposite mentality.
I see. So my understanding is that you had to burn that gambler's mentality out of you. Was that difficult?
Yeah, it was. Look, when I first started trading, well, God, 6 years now, I guess it was 6, 7 years now. I blew out my account twice. Just completely blew it out. I came into it thinking, well, I know what I'm doing. I got this, no problem. And the screw ups I had are no different than probably everybody else's. And it was still that gambler's mentality, right? It was still that chasing those low float momentum stocks and trying to counter trend trade. I know better than what the market's doing. Oh, this is going up. Oh, I'm gonna short it. And so I had that. It was basically, okay, I'm not going to a casino. I'm going to gamble here instead. And it was the same mentality. And then the second time I blew it out, I was just sitting there and I realized, yeah, okay, I'm not trading. I'm gambling. I'm just treating this like another casino.
Right. So your time when you were gambling in the casino, did you get disciplined eventually about and how successful were you toward the end?
Towards the end, well, one, if I was generally fairly successful. And I became disciplined in terms of, when they used to be able to count some cards into a blackjack deck, that the rules they have now, it's kind of prohibitive. But I became pretty disciplined in, I would be able to win in a poker room and then not basically get to that elevator with the money still in my pocket.
Mm-hmm. And was that discipline difficult to apply when in the markets when you first started getting?
Yeah, it was. Mm-hmm. It was very difficult because the instinct just took over, right? It's sort of like it's like a drug, and it immediately took over when I started. And then I started to figure out, how am I going to get this under control? And it was, okay, can a retail trader beat the market? Is it even possible? Is it possible to consistently be profitable, right? Because you can be profitable on any one or two trades. Anyone can go in there and get lucky, just like anyone can go into a casino on any given day and have a good weekend and get lucky. Is it possible to be consistent? So I started looking around and seeing, are there traders out there that actually do this for a living? And it turned out there are. So when I knew and found out it was possible, then I just had to figure out how. And that kind of set me on this is a puzzle. This is something to figure out. And that I can do. I can figure out puzzles. And so that's what I set my mind to. And that's what took away sort of that gambling mentality when it became something, a challenge that I had to crack.
Mm-hmm. From my understanding, you had a career as a professor of sociology and statistics.
Yep.
Yeah, and so you had a career with that, and my understanding is that your early investigation of the markets came across as rather boring to you.
It became, well, I mean, my initial thought was, well, is it predictable? And whether or not one could predict the market. And then, of course, the more I looked into it, I realized, okay, people have been trying to do this forever, and it's the largest data set in the world. There are institutions with supercomputers that are trying to predict the market. And, put sociological economic theory on. No, I don't think you can create a model to predict the market. But I do think that you can create and find methods that can give you an edge. And statistically, that's all you need, right? You need an edge in order to be successful. And that's what I started to become interested in. It's possible to find an edge.
Mm-hmm. Did you have any other friends or family that were in the markets prior to you that kind of gave you inspiration to get in? Hey, yeah, they're doing pretty well too, and I can do well as well.
No. I try to avoid talking to family and I have a couple of friends. I have a couple of friends. I mean, I don't like people, and I try to avoid them. The pandemic for me was, hey, I could stay in the house, great, and not see people, which being in the movie industry was not the easiest thing to do, to avoid people. But people who were in the market, but they were long-term investors, right? They had their money in the market. They, invested in the blue chip stocks, whatever, and that was it. They weren't long-term investors, right? They had their money in the market. They, invested in the blue chip stocks, whatever, and that was it. They weren't traders. So I didn't know person till I came across, like anybody coming in, I looked across various different trading communities, and 95% of them are frauds and scams. And it was clear right away that, okay, these people are like vultures. Here you have people coming in who want to make a better life for themselves, and the first thing they get hit with is some asshole in a Lamborghini on a YouTube video telling them that they can, become millionaires overnight. And so I looked and finally found a community called One Option, which I joined and have been in ever since. I'm a member there. I now kind of run the chat room for them, but to me, that is a community of other professional traders that I'm able to exchange ideas with and then help traders, turn this into a full-time profession.
Mm-hmm. When you first started getting in trading, were you doing okay financially in your career? Were you motivated to get into trading for the challenge?
It was a challenge. Yeah, I was doing fine. I co-ran a studio at the end of my career in the movie industry. I had just released a movie called Unhinged with Russell Crowe, and yeah, I mean, it wasn't out of financial need, but it certainly was I don't want to do this anymore, right? I feel I've reached the pinnacle of my career here. I've created things, invented things. I've changed the way they do things in the movie industry. Now I want to try to tackle this challenge. So, blowing out the account twice certainly wasn't fun, but I did it for the challenge.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, You don't need millions or even thousands to start trading the US stock market. Bypass the PDT and tap into over 12,000 US listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Share with us, how did you blow out your account?
Well, I started like anyone else. I opened up a Thinkorswim and put about $120,000 in it, and started trading. And I would go long Amazon or short Google, and then I got introduced to options, and I'm like, oh, these are great. This is options are fantastic. Look at this leverage, and that kind of just was the death knell, right? So within about 4 months, those options just crushed me. I was going, out of the money options. And like I said, I was treating it like a casino. And even though I knew out of the money options statistically are a shitty idea, I did them anyway. And account went to zero. And then what did I do? I put more money in. So, and then quickly, within another 4 months, blew that out too. And so then I'm sitting there and I'm like, well, fuck, I got to figure this out. And I am not putting another dime in until I figure out how to do this consistently correct. And the next time I finally put money in, I still haven't looked back from that deposit many years ago.
Oh, wow. Of the 90% of traders that are reported to lose money, how much of this is due to the gambler's mentality, do you think?
I'd say a decent amount. I mean, look, the 90% of traders, Tom Hougaard, says it best. They're fearful when they should be hopeful, and they're hopeful when they should be fearful. And it's like chess, right? It doesn't take you long to learn how to play it, or poker, the rules. The methods might take someone a month or two to learn, but the mindset takes 2 years at least. And it's 2 years of hard work. When people come into the real day trading, which is the subreddit I created, and now it's one of the top 5% subreddits on that platform, they get told right away, this will take you 2 years minimum to learn. And it's a hard 2 years, because if you think about it, think about the job. You get to wake up, roll into your office, which is right down the hall, sit at a computer, make money, get up when it's done, go enjoy your life, and never have to worry about financial security again. As long as you have an internet connection, you can make money. What is that worth? Like, how many years do you spend slaving away to get to a middle management shitty cubicle somewhere? So if someone thinks they can just and friggin' spend a week and get rich, I mean, what the arrogance of that idea is absurd. I had it when I tried it. It's just absurd when I look back at the hubris of it. Like, no, this takes hard for going to lose their money.
Mm-hmm. What parts, of the 2 years that you say that is needed, what is the most time-consuming aspect of that? Like, what is the most difficult and challenging part to learn?
It is the mindset of not cutting your winners and not holding on to your losers. And I lay out sort of first you have to spend at least 6 months learning everything. And when I mean learning, I don't just mean memorizing it, understanding what it means, understanding what an option really is and how it works and what market makers do. Then you go into paper trading and you have a goal. You need to be a win rate of 75%. You need to have a profit factor of 2 or more, and you need to do that for 3 consecutive months. And then when you do that, then you can go to the next stage, which is 1 share. You can trade 1 share at a time, and you have to hit those benchmarks again. And it takes about 2 years before people do it. But at the end of 2 years, what they're really doing is slowly shifting their mindset to the right successful one that you need to become a successful trader.
Mm-hmm. So your early trading. So how did you turn around your early trading mistakes?
It was, first thing I needed was, okay, it's possible, right? I see people doing it now. Now I need a method, right? What is the method? When I looked around and I saw people like Ross or whatever, and he's very good at scalping, and I looked at it and said, like, that's not a sustainable method for most people. There has to be a statistically sustainable method. And what I realized is the market has a centralized ETF, right? SPY. So when someone says the market, in general, you're talking about the S&P 500, and let's just call it SPY. And stocks, whether they're in that ETF or not, kind of revolve around the orbit of SPY. And about 75 to 80% of them, when SPY goes up, the stock goes up. SPY goes down, stock goes down. Certain stocks on any given day are relatively weak to SPY or relatively strong to SPY, right? And I'm not talking about the shitty RSI indicator. No. And so like today, for example, Amazon was weak to the market. And what happens is if you short Amazon there and the market goes up, yeah, Amazon's going to start slowly creeping up, but you have a buffer. It's not going to go up as much as if you shorted, AMD or a stock that wasn't relatively weak. So if you start looking for stocks that have proportional strength or weakness against the market, it's sort of like having that wind at your back. And if you have a bunch of people running a race, you want the person who can take the lead when there's a 100-mile-an-hour wind coming at them. And then if the wind reverses and hits them in the back, you know they're going to win. So you're looking for those stocks. So I started scanning and looking for those stocks. And that was sort of the method that got me going, which obviously is more and more refined now, to become a successful trader.
Mm-hmm. Does this relative strength also apply for stocks not in the S&P 500 or sector-specific stocks in the commodities, for example?
Yeah, 100%. It does. I mean, look, there are certain stocks like biotech sometimes go and they do their own thing, or stocks that are under $10 or $5 with low floats, they'll do their own thing. But even if a stock is not in the S&P 500, the gravitational pull of it is strong enough that it does impact those stocks. And you can measure relative strength and relative weakness of those stocks against SPY, whether they're in it or not. You could try doing it with QQQ and tech stocks, but even there, SPY winds up being a better predictor of a stock's movement. So it's not just restricted to those 500 stocks.
Mm-hmm. And to add additional weight, do you ever look at the stock's relative strength to the sector that it trades in as well?
I do, yes. And stocks can have relative strength to their sector, where obviously if, the tech sector is down, or today, for example, financial sector was down, and a stock in that sector happened to be up. Now, many times when you have strength against your sector and you're not going in the direction of your sector, it could usually be news related. And that is what makes, ask any professional trader, and they will tell you right now, this market is probably one of the most difficult markets, if not the most difficult market to trade. And I am trading 2 accounts here. I'm trading one account through JP Morgan, which is a rather large account. I have a desk of analysts there, and I have a Bloomberg terminal, and I go through that with them. And then I have an Ameritrade account. And, talking with them, no matter what this is the most difficult market, this particular market in the last, let's say, 4 months.
Well, why is that? What makes it so difficult?
Because all traders, we ply our trade still based on the acceptance of technical analysis. The technical analysis is based on, obviously, sort of a group think. If we all think that the simple moving average, 50 simple moving average is going to apply support, then it's support because we all think that. This market, though, look what happened today. A non-voting Fed speaker decided to come out and be all dovish for no reason at all. They come out and they just start spouting. Bostic decides to come out and start spouting all these dovish, maybe we'll pause over the summer and blah, blah. And the market shoots up. This market is so sensitive right now to any type of news. I mean, when we were in a bull market, I'm sure you remember, Ian, we didn't know what the hell the CPI was. I mean, we knew what it was, but we didn't know every month, like, oh, it's a 7%. We didn't pay attention to the jobs report. None of it had an impact. But I mean, maybe a couple, if the president tweeted it did, but in general, those things didn't matter. But now, every single day, there's something that could drop. A news piece, article, or an economic release, or a Fed speaker that can cause your technical analysis to go right out the friggin' window.
So do you view that these news events as even more important than company fundamentals, earnings releases, that kind of thing?
Earnings releases are always going to be probably your biggest catalyst on a stock, and I don't recommend playing earnings. I mean, other than there's certain types of trades that you can use that can take advantage of the economic environment. So one of the things I tell traders and to help them along their way as they're doing this journey is to familiarize themselves with the macroeconomic factors, to know what it means when the 10-year yield is over 4%. Why is that bad for equities? They should know that. Why when the Fed raises rates, why is that bad for tech stocks more than it is for energy stocks and so on? These are things that normally pure chartist and technical analysis would normally say, oh, I just need the chart. Just show me the chart. Can't do that anymore.
So was there a time in the past then that one could just use the chart? Was that a year ago before the market topped out in late?
Yeah, I believe during pick your time during the stretch of the bull market. Other than that sort of instability during the initial COVID drop. But generally, when you had a trending market almost 3 to 4 days out of the 5 a week, and when you have a trending market, you just throw a dart on the strongest stock and off you go. You just make sure you have a good corresponding chart, daily chart to the direction that you're going, and you're off to the races. Now, not so much, but yeah, I would say you could rely primarily on the chart in front of you and what's happening with the market before we started hitting this let's call it January, what was it, 2020, right in the end of 2022.
So what do you think it's going to take to break the market, either into a steady downtrending bear market or reverse course and go into a bull market?
I got to tell you, I'm freaking sick of being a bearish trader. I freaking hate it. I think, this market's not going to capitulate. There's no reason for it to, but right now there's no catalyst either. And as long as the treasury rates remain where they are, why would institutions, and let's be clear, our job as traders is to figure out what institutions are doing and follow the money, not go against them, not, everyone's like, damn the man and hate the hedgies and all that. Great, whatever. When you grow up and want to make money, you will realize that your job is to follow the money. And institutions have no reason to put their money into equity while they're getting 4% or higher on those yields. So what will it take for those yields to go down? Well, what will it take for the Fed to stop raising rates? And then you have inflation, right? So inflation has to markedly come down, and the market has to believe that there is an endpoint, a terminal rate endpoint, and then a point where they start reversing those hikes. At that point, you will start seeing real bullish rebounds that will break out of the cycle. But until then, everything should be treated as just a bull rally in a bear market.
I see. Well, why do you think we haven't seen a massive sell-off in the stock market to the point where we see the VIX index spike sharply higher? It seems like this market doesn't really want to go down, even though people describe it as a bear market.
Yeah, to be honest, it's because the economy is still freaking good. Because you have almost universal employment. Households have more discretionary funds now than they did before COVID. You have declining debt, even on the average debt on credit cards. So when you have an economy that's strong, that is handling these higher rates, there's no fear of recession. Now, if we were going to go and into the hard landing or whatever they were call it, into a recession, then you would see that capitulation, you would see that selling. But as long as the economy stays strong, then the earnings on these companies are going to be decent. They might not blow the doors off, but they're not going to miss by and large. So as long as that happens, we're kind of stuck in this horrible chop fest crap zone of nowhere land, of 380 to 415 SPY.
Yeah. Could you share with us how you go long or short? What do you look for in the charts?
Sure. So I have my scanner over here, which is a system called Option Stalker, even though that it's not just for options, but so it's called from that same one option community. And it scans for stocks at relative strength and relative weakness. I then use TC2000 over here, and I look for stocks. Let's say I'm going long. And I'll give an example of today, for example. I'm looking at, let's say, AMD, right? AMD, which should have a news event, but AMD started becoming relatively strong to the market, proportionally strong to SPY. It breaks through its 200-day moving average. It breaks through its downward descending trend line. So it breaks through two layers of resistance. And now I have a stock that I can go long using the stock or options. And when I use options, I use deep in the money options. And if it turns against me, I can hold that position because I have a correspondingly good daily chart, and the market closed above the 50 SMA today. So I have a market in a bullish uptrend. I have a bullish stock with a bullish daily chart. Those all combined with a relative strength, I can stay long this stock going into tomorrow and have a fairly good chance that this stock will continue its run upward.
Mm-hmm. My understanding is you like to use what's called algo lines.
Yeah. So the best trader I've ever seen, to be honest. The man has a 92% some odd win rate. He discovered that if you take trend lines and you start them at very high volume candles, that it ties it into, and he also has people that he knows at institutions, their algorithms are, their systems basically will draw every possible trend line on a chart that you can imagine. and narrow it down and narrow it down. The ones that start off high volume candles and have the most number of touches along them and so on, respect time and time again. A break through those algo lines is basically triggers on the institutional side of buying or selling. And you start seeing that in the volume. You start seeing institutional level volume with it. So we call those algo lines.
I see. How do algo lines differ from the regular trend lines that many people are familiar with?
They have to start with a candle that is a daily candle that has volume over the 50-day moving average. They can't start with an earning candle or candle the day before or the day after it. They have to have at least three touches, I believe, 3 touches to them. So there are certain rules, but essentially they're very similar to it. But I would say maybe 20% of all trend lines are algo lines.
Mm-hmm. I see. So when you say do what the institutions are doing, are we referring to going long stocks that are breaking like above a compression zone where where 2 different algo lines meet?
Yeah, absolutely. Look, if a stock is in kind of compression, it breaks above that compression, it breaks through a layer of resistance. It does so with volume. There is clear continuation. You have it confirms that breakthrough. Then you're looking firms that breakthrough. Then you're looking to see is this have institutional volume? Is this have relative strength to the market? Because what would give a stock strength that is independent of the tailwind that the market itself is giving it? Retail traders, we all like to think that we can move stocks, right? And it happened twice, GME and AMC. Other than that, retail traders is like herding cats. We don't come together and pull our money into one stock or another stock. It's disparate. It's spread all over the place. So institutions are really the ones that are moving the price, and they're the ones that can push that type of volume, and that's what you look for.
Mm-hmm. You have a funny little quote referencing an Animal Farm reference that all support and resistance lines are equal, but some are more equal than others. Care to explain that one?
Yeah, that was a while ago. I wrote that in the wiki, and you might hear the phrase "read the damn wiki," which is a phrase they came up with in that community, which even though people refer to it as a cult, I'm telling you, it's not a cult. Although I would like to get a commune one day. That would be nice. Maybe in Kansas, that could be good too. Anyway, the point is that obviously certain lines of support and resistance are more stable than others, right? And you can create any line, I got fib lines, fuck off with your fib lines. There are certain lines that get universal agreement, the SMA 50, 100, 200, certain trend lines, horizontal lines that a stock will support. And the question then becomes, 1, how strong is that level of support and resistance? That's the initial question. 2, what will it take for a stock to break through that? Does it take a news event? Does it take just a strong market and a strong sector? Does it take earnings? And so you begin to see, all right, for a stock to break through its 200 SMA, you need to have the following, right? That's a stronger level of support and resistance than, let's say, the 8 EMA, which can be broken constantly. So there are different levels of, not all support and resistance is created equal. And when something breaks support and resistance, it's a question of, well, what type of support and resistance did it break?
Mm-hmm. You mentioned also that trading is contextual. Having a checklist is simply not enough. Is that what you're referring to here? That a combination of different factors that influence? Does it influence how heavy you go into the trade?
I think I remember when I said that, and because it drives me nuts that every month I get people coming in saying that they've created their own, algo on how to trade, and it can auto trade for you. This thing can trade for you. All it has to do is stock has to meet the following, check, and then boom, buy. And it's not that to meet the following, check, and then boom, buy. And it's not that simple. It's simple because everything is in context. Everything is just because, that stock is relatively strong and this, but there is, the CPI report coming out tomorrow, but there's, that stock, doesn't have the volume that relative to the other stocks in its sector does, or et cetera. Everything, as a trader, you have to take everything into context when you're trading. And that is one of the reasons it also takes as long as it does, because that's something that you get with experience, right? That's something you get with time, where you're able to look at the larger context of it and see, okay, this is a temporary bump here, or this is because this is profit taking. This is not a real dip in this stock. This is going to rebound. And even though that might check off all the, I should short this, it's not going to work out, because if contextually you look at it, you could say, okay, this here clearly just reached a high here. This is profit taking in the stock. You need to wait for it to find support and then rebound.
Mm-hmm. You mentioned about people creating algorithms. I remember a quote that you said last year. You said, do not decide on a strategy based on backtesting. Care to tell us why?
Yeah, because you can backtest anything and it's going to give you a 80-90% win rate. I can backtest a 3/8 EMA cross and it's going to tell me that I have a 90% win rate with that. But I don't. You mean, if that were true, then we'd have a lot of successful traders. Backtesting is just begging to overfit the data. And you're not going to be able to get in and out of the positions as quickly as the computer's doing when you're backtesting those conditions. It's going to go, 3/8 cross, really tell you what does work.
Mm-hmm. How do you apply risk management?
We're currently on right now. And none of them have any stop losses. I know exactly where on each one I would want to get out or not get out, but the conditions change. I don't get out or get into a stock based on my P&L. In fact, the P&L should have nothing to do with your decisions on exiting a stock. If it does, you've over-positioned your trade. You should get out of the stock when the chart or the thesis that you have is no longer valid. That's when you need to exit the stock. Now, you take profit, that's a little bit different. Now, if you're taking profit, my recommendation is that people should add to their winners more and not take profit as quickly as they do. That's like number one thing. But when you're in terms of exiting, if you're exiting because you think you've lost too much money, that's not the right way to trade, and you're going to just fuck yourself over time and time again. You need to exit based on the chart, and so a preset stop loss, to me, it's sort of conditions are going to continually change. So I want to be able to stay flexible with the trade, and particularly in today's market where a stock can go bang down and up and just trigger those stops. It's just people who play futures and then they put in these stop and they're constantly getting their stop is triggered. It's like, dude, just you're gonna every single time the market's gonna smack you down.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
Mm-hmm. So your risk management is just knowing visually where on the chart you're going to get out, and you position size yourself, and you feel comfortable with just manually taking the trades to get out of your positions as they unfold. I mean, it sounds like you maintain a somewhat flexibility toward that, right?
I do, yeah. And look, trading is a business, right? You have to treat it like a business. And so, like a business, at the end of each month, I know, and over thousands of trades over the course of several years, this is my average win rate. This is my average number of trades per day. This is the average amount of profit I'm going to get per trade. And by the end of the month, I'm going to come within my target revenue within, X%, 2 or 3%. Some, there might be some months where I missed it by a few percent, and some months where I go shoot over it. But the key here is if I find myself getting, had a great month, that's actually not a good thing. I want to be consistent. And so I know if I use this setup in this situation, I'm going to have an X% chance of being profitable on this trade. And as long as at the end of the month, those numbers match up and stay within that range, I'm good. And then what I do is every 6 months, I increase my base by 15%, and then subsequently increase my target range of what I expect to take out in profit at the end of each month proportional by the 15%. So 32% a year, but at the end of the year, my base in account is 32% larger than it was the previous year. And so are my profits. So they just keep growing that way. It's a slow growth, but that's a growth I'm comfortable with.
I see. For less experienced traders, don't you think that having stop losses are helpful in the beginning? It's often, the standard rule of thumb in the industry is that stop losses are helpful to protect you from yourself. And you've certainly developed quite a talent for not needing them. But I imagine most traders do need them, right?
Well, I mean, the 90% that are losing, I mean, they're using stop losses. So they're all following those rules of thumb. Look, I think.
I see. So you've created a group on Reddit called Real Day Trading. What was the motivation to create this group? It
was an absolute frustration with the groups that are there, and everyone knows about Wall Street Bets, and they have other groups there, day trading. And you go on there, and there are tons of people. It's the internet, right? So you have a bunch of well-meaning idiots, and by that I mean people who aren't if you're not a profitable trader, why the hell are you giving advice to people on how to trade? But that doesn't stop people, right? So these forums are filled with a million, you need to do this, you need to do that. And most of them are all wrong. And you have people shilling shit on there. And so I go to the mods of these groups, and I'm like, what the hell? Like, what are you doing? These people are losing money. I'm getting notes from people. Now, I would write posts there, and it was, these posts in these forums became like the top 3 posts of all time in each one. And I'm telling the mods, like, these people are losing money. I'm getting all these messages, and they didn't care. They're like, oh, they know what they're doing. They're fine. One of them even said, oh, people are here to gamble anyway. And so I got so frustrated. I said, you know what? I'm going to create a group that if people want to learn how to really do this for a living, then they can come here and realize it is going to be difficult. But if anything is posted in this group, it is vetted. And it is done by, I asked a couple of professional traders to come join me to help. And nothing posted in that group is something that isn't vetted, that isn't proven. And so I personally, how else am I personally doing? But anyway, post every trade I make live in real time, entry and exit. I post the trade, today I post the position size. There, time. This is when I entered, and this is where I exited. And you can go back and check the chart. So there's no way to Photoshop it, or this is my trade record. And they see this is the method being used. This is how it's working. And then I wrote a 300-page wiki. They call it the wiki. And this is your manual on how to trade. And I do not charge people. Why? Because I don't need their money. They need their money. I'd rather take money from people that have it. I don't want to take money from people who don't. So here's the wiki on how to trade. But if they join this group, they have to be serious about wanting to. If they are not serious, if they're a troll, if they're messing, they get kicked out. And some people said it's got a little cultish atmosphere to it, whatever. But guess what? People in this group, you start reading the testimonials after a year of people in this group. People who came in not knowing, like losing money, have left their jobs and they're professional full-time traders. And I'm not talking about one or two people. I'm talking like well over, I'm not being hyperbolic, well over 100 people in the last year have become and left their job and became professional traders and are now also posting their journals and their trades. These are people who were like on their last leg and now they have financial freedom. So it is a commitment, but they come into this group and then they also I don't run the one option group, but I'm in that chat room. And so if they want to talk to me directly, they can come and that's the group that I'm there as well. And I'm posting on Twitter. So I'm accessible to people. And it's, an education. It's kind of like a school. It's like a boot camp. And that's I want to change the way I want trading to be seen as a legitimate method of employment, that, you should be, declaring yourself a trader to the IRS and get trader status and go full time, but not before you're ready. And I constantly tell people, stop fucking trading. You're going to keep losing your money. Don't trade anymore. You need to learn. You need to fix your mindset first. It's insane. People doing the same thing over and over and over again.
Yes, I notice you spend quite a bit of time in writing and in videos talking about helping smaller traders and focusing on small accounts, often below $25,000. And you mentioned about setting up extraordinary high probability trades. Could you share that with us?
Yes. So most traders who are under 25,000, they experience the bullshit pattern day trading restrictions of you can only have 3 day trades a week. And so to get around that, they decide, I'm going to have a cash account, which is just a really bad fucking idea. They should have a margin account so they can do spreads. And the reason they want to do spreads is because on any given day, you will find 1 or 2 very high probability trades. And a high probability trade is a trade that, you have a stock that is trending with the market. It has relative strength. It has a good solid trend. It broke out of compression. It broke, everything is lined up with this stock that you once or twice a day, you will find a trade like that. And those are the only ones you should take, 1 or 2 of them. And you take them as a spread, as a call debit spread, or you can take them as a put debit spread. So you mitigate your risk and you mitigate your, you can use a higher position size and still get a decent return with those spreads, and they're high probability. And that is what traders, I would run these challenges, start with $5,000 and I turned it into 10, it turned it into 20. I would start with 30,000 and do all transparent. Here's my journal. Here's all the trades. And I would keep doing these challenges. And the most difficult challenge to do is the low balance challenge. The $5,000, if you try to apply it in typical ways, doesn't go very far. But if you're very selective, like for example, an out of the money bullish put spread, right? Where you get a stock that is bullish. Take, I don't know right now, maybe Adobe or whatever. And that's not a bullish stock. And it has 2 layers of support underneath it. Then you do a bullish put spread, a put credit spread that is about far enough out of the money, and you can get 20 cents to every dollar on it. So, for example, if I were to do, let's say Boeing right now, and Boeing's at 210 at the moment, and I look at Boeing, and Boeing has support at its 50-day moving average at 205, and then it has support down at 200 right below its consolidation here. So if I went out to March, let's say 31st, and I did a 195, 190 bullish put spread, I would get an order for me to lose there. Boeing would have to fall below 190, which means it would have to break through several lines of support in order to break. So the win percentage on those trades is about 92%. And as long as you're getting a 25% ROI on them, you're going to percent ROI on them, you're going to come out ahead. And so I recommend, taking trades like that, which are better in a bullish market, but there are certain ones like Boeing right now, the 190, 185 bullish put spread on Boeing, giving you $1.28 credit. You get 5 contracts of that. That's $600 as long as Boeing stays above 190. Okay. If it doesn't, well, then you buy back the short put and you ride the long put until you hit the credit mark.
So you mentioned that these type of opportunities, you can find them every day.
Yeah, with the right scanners.
Mm-hmm. Great. I'd like to transition to psychology and
Sure.
a wrap up. What do you currently struggle with the most in your trading?
What do I struggle with the most? Going on tilt is still an issue for me. I will sometimes do Twitter spaces where people can listen to me trade. I'll talk through the trade and they can hear me sometimes just lose it on the market.
Mm-hmm.
So going on tilt, controlling my emotions are still an issue for me. And over trading can sometimes still bite me in the ass, where I will overtrade, take too many trades for the day, where I'm monitoring just, way too many trades. And in the morning, I'm missing opportunities because I'm managing 15 different trades. So over trading and going on tilt. But, when I'm trading, I'm also, every trade I make, I'm posting here, I'm posting here, I'm posting here. I'm talking to traders, I'm answering questions. So it's sort of, I have a lot going on as I'm trading all these accounts, and it sometimes gets to be a lot.
So how do you practice to not overtrade?
I would say Norco helps. That certainly is a good, calms me down. I mean, basically what I have to do is sort of rein myself back in and look at, okay, obviously not all of these are high probability trades. And then I just need to start, I go through them and pare them down, even though some of them are losing, they're underwater. I just start cutting them now because they're not high probability trades and I shouldn't have taken them. So when that's difficult for me to do. I hate losing just like anybody else. And so cutting a loser for me when technically I'm looking at the chart and I'm like, okay, my thesis is still correct. And the other thing is I've been known, I'll put a thesis out there that says the market is going to go down. And I have a bearish thesis on the market and I'll give all the reasons why. And it sometimes doesn't happen the next day or the day after that. And so I'm holding all these shorts and gets to that point where it's like, I know, and gets to that point where it's like, I know I am still right. I know it's going to go down, but I'm getting killed here. And eventually, yeah, it'll go down and it's fine. But it's like, that's really difficult where your thesis is being tested, like right there, and you're looking at yourself like, I'm losing all of these friggin' trades and I still know I'm right, but God, when is it going to happen? And then boom, eventually it happens and you're fine, but it's just very stressful, particularly when you have, thousands of people who just love to say, you were wrong. It's like, all right, fuck off.
Have you introduced trading to your children?
I have my 17-year-old, and I I tried. He's learned about it. But look, I offered him, I said, here, I will give you an account, put $5,000 in it. You trade it. And when you're done, whatever profits you have, donate to charity, and you will learn. And you can keep some of the money for yourself. Mm-hmm. And you just have to tell me when you're ready, and I'll do it. And I'll know you're ready because you've chosen a platform, you've downloaded one, and you've practiced, and you're ready to go. I'm still waiting, but he's 17. He's about to go to college, so I don't know. He wants to get into finance. I assume at a certain point he'll turn to trading. And my other son's 3, who will run in and tell me, "Daddy, I Mr. Splinty made the market go down," and he's referring to a splinter in his thumb.
Oh wow! So in the future, are you still desiring to move to Nebraska so you can watch the tornadoes?
I've moved it to Kansas, but yes, I want to move there, get a nice place, sit on the porch, watch the tornadoes roll in, and the nearest neighbor is miles away. Going into town is a big deal. I just want a place where I'm far away from people. And, LA is filled with people, but any place that's nice and far away, and I can see I love thunderstorms, severe weather. I can enjoy that. I'll have internet access, and I could just be a hermit out there. That would be nice. But
yeah. Are you familiar with the Tornado Hunter show?
I am. Yeah. I would actually I'd gladly do that. And hop in one of those vans. That sounds like fun. Yeah. Of course, the other half of me is thinking about putting on a real day trading conference in Vegas, and getting all these people out there and holding seminars for them. So I'm of two minds. I'm kind of like, if I'm doing something, I'm always sort of like, I don't know. People think I would go crazy in Kansas by myself out there with my wife, and she'd probably go crazy too. But that is where I want to wind up.
Mm-hmm. Well, thank you very much for coming on the show, Vincent. How can our listeners get in touch with you?
They can on Reddit, the subreddit Real Day Trading, all one word. Go under the name H. Selvin, and if you go in there, it'll be easy to find me. Just reach out to me there. You can reach out to me on Twitter, Real Day Trading on Twitter, and or in the One Option community. Any one of those 3 places. Reach out to me. I'm accessible. I will always generally respond within a day, especially if someone needs help, if they have questions. If the question's answered in the wiki, I will say read the damn wiki. But if it isn't, I'm always happy to give my time to help someone who is struggling and try to show them maybe a different path that could get them to where they need to be.
Great. Yes, I found the Real Day Trading group on Reddit an excellent source, and your videos on YouTube are also very good at visually seeing what you're talking about using the charts.
Great. Well, I'm happy to be here. Thank you for having me. And